Good evening, everyone. I hope my voice is audible to all of you. May I get a quick confirmation over the YouTube chat box? Is my voice audible? Let everyone join. Let us wait for all. Okay, awesome. So I think many students are here, yet some of us will be coming in as well. So I hope everyone is doing well. So let's begin with our session with a smile. And I know there is a bit of anxiety and a bit of nervousness that the paper is around the corner. What's going to happen? Are we going to pass or not? So all those things. As a tutor, I see it every quarter, but for you, it is a new thing, especially for FR or SBR, whichever exam you're preparing. So let me just tell you all the students. Right now we have 155 students here. So all these students are in the same boat, literally the same boat. So it's like all of them are facing the same level of anxiety, the same level of stress, and they have all same doubts. Will I pass or not? And I've not prepared well. So it's like the ones who are sitting with you, they are also in the same boat only. So don't think that you are extra worse. Okay. So all are in the bad position right now. And that's why we are here. And we are supposed to discuss our anxiety and to, cover the concept so that we can have the confidence before the paper. So all my students who are AAA students, they were given this confidence 2 days ago. So you are all here, FR and SBR students today. I just assure you one thing. I just assure you one thing today, the ones who will watch this debrief, this revision till the end, you are going to go back home with lots and lots of confidence. I just need your full attention, focus, and participation. Okay. So when I say, are you clear? You need to give a thumbs up. If you have a doubt, you need to post it. If you think that, okay, I am, after 30 minutes, we lose the track, we lose the focus, you have to bring yourself back to the session. So please sit back straight. Nobody will lay down and watch this video. Nobody will walk around and watch this video. Nobody will drive and watch this video. You need to sit back straight on your study table and pay attention to the revision, which is just going to start. Awesome. Okay. So to begin with, all the students who are here from FR, FR and SBR has 75% similarity. So first I will cover that similar portion, which is 75% same. I will revise that. Okay. And the students who are from SBR, you will remain till the end. By the time I'll be done with the FR portion, I'll tell the students, okay, goodbye, you can go now. Okay. So FR students, you are here for a shorter duration. SBR students, you are here for a longer duration. So let's begin. Let's begin with our session without any further ado. So today I am here with a Word file rather than just a whiteboard and explaining you things on board. So today I thought let's take it in a different way, in a different manner. And I believe you all are so acquainted with typing now since ACCA exams are CBE. So let's do it in the same fashion as well. So that by the end of this session, you guys actually have the, you know, script with you. The notes that I'll make today, you'll actually have those notes with you. So that is the reason I've opted for this Word file so that we remember what we do, like we highlight the words. I will type the notes for you. And after the session, you can refer back to these notes for your revision. Now, that is what is known as productivity, right? So let's be productive. Let's start with our session by taking God's name and with a big smile. So let's start. Conceptual framework. Now, what in the world is conceptual framework? Conceptual framework is the Bible of accountancy. Conceptual framework is Bible of accountancy. Now, when I say Bible of accountancy means what? Are you saying accountancy is a spiritual topic? No. Bible of accountancy means, or not Bible, any religious book. So every religion has their religious book where we refer to, okay, if you don't believe in God, don't mind me. But when you're stuck in a position, when you are stuck in any situation in life, you what do you refer to is you refer to your answers in this religious book. You look for some mentor, you look for someone who can guide you. So that guide in the life of the accountant, that guide in the life of the accountant is none other than conceptual framework. So conceptual framework is like Bible of accountants. Okay. Now, what do we get from conceptual framework? What is the advantage of conceptual framework? It tells you about the underlying principles. It tells you about underlying principles of accounting standards. So you all know that we have accounting standards, and that is the reason these two paper exist. That is FR and SBR, and that is the reason accountants exist in this world. What is the work of an accountant? The work of an accountant is to prepare the financial statements. What are financial statements? P&L, balance sheet, OCI, cash flow, statement of changes in equity. That is the work of the accountant. And the accountant actually has to prepare this with the help of IFRS. So all these standards, accounting standards, vary from country to country, state, I won't say state to state, but country to country. Like we have local standards, UK GAAP, US GAAP, Indian accounting standards, Pakistan's accounting standards. So we have, accounting standards relevant to every country. But the language which is global is IFRS, that is International Financial Reporting Standards. So we are supposed to learn IFRS. So accounting standards means IFRS, that is International Financial Reporting Standards. So conceptual framework tells you guys that whether the quality of financial statement, how it should be taken as, what should be the quality of financial statement? Quality of financial statement. You know what is financial statement? Conceptual framework tells you how good you should prepare it. So there are qualities which are primary qualities, and then there are qualities which are secondary qualities. So what are the primary qualities of conceptual framework? That the financial statement should be relevant, okay, and they should be giving faithful representation. What in the world is relevance? Okay, if I start singing a song here, do you consider that as to be relevant? I'm here for SBR and FR Grand Revision. I start singing a song, or if I start telling you that I ate this for my lunch, is that relevant to you? That's immaterial. That's not, you can say it's not linked to what we are doing. So in financial reporting, what you are doing is you are reporting, you're communicating the numbers of a business. So you are not supposed to divert from the topic and start talking about something else in your financial reports. So you are not supposed to report something which is immaterial. So you can't tell the users of financial statements that, dude, we bought these many sharpeners in our stationery. We bought these many pens and pencils and erasers. So you're not supposed to tell all those things. That is something which is irrelevant. So what is relevance? Relevance is when I include things which are material in my statement of financial position and statement of profit and loss. So everything which is relevant is material. It is not diverted from the topic, but from the topic. What is faithful representation? Faithful representation is CNF. What is CNF? Complete, neutral, free from error. CNF. The financial statements must be complete 100%. Things should be included, whether it's sales, whether it's purchases, whether it's your expenses. You should not miss on anything. So CNF should be there. Plus, faithful representation has substance over form. What is substance over form? Substance over form is that I believe in the economic reality of a transaction. I do not believe in the legal transaction. Ma'am, example, sale and lease back. What is sale and lease back? You sell something. So in papers, you actually sold. You will, do a sale agreement in a reality, in legal terms. You will do a sale agreement, but then you will take it back on lease. So if I go legally, then there's no point of calling it as a sale or not a sale. But if I talk about its economic substance, I do have a concept where I might consider it as a sale or I might not consider it as a sale. because economic substance is whether the control has passed or not. Control is the risk and reward of any asset, right? So we need substance over form. Example, sale and lease back. Example, sale and lease back. So we also need to consider economic substance in case of you sell something and then you have an option to repurchase it. So even that, you know, even that is something that you need to consider. So these are the things which we have in our primary qualities of financial statement. Now let's move on to the secondary qualities of financial statement. What are the secondary qualities? It should be comparable, it should be timely. That means I should give the financial statements on time. I should make sure that they have consistent applications of accounting policies from previous year to current year, from our business to the you can say similar companies in the industry. So I need the same kind of comparability across. And then what else can be there? So these are the things which are primarily there in the secondary qualities: comparable, timely. You can also talk about understandability, okay? That they are understandable, they are in simple words, in simple language, they are verifiable. That means you have a source document to actually find from where is this transaction coming. So there is an audit trail. There is a source document to which I can vouch it back. So this is what I mean by secondary qualities of financial statement. Right. Now what we have is definition of elements in financial statements. What all financial statements are there? I told you P&L, balance sheet, and cash flow. Now within that, what all things do you record? You record asset, you record income, you record expense, you record liability. So what is an asset? Let's talk about what's an asset. Asset is asset is any economic resource which you control due to a past event, right? So it's an economic resource which will lead to inflow of resources which you control due to a past event, right? So here the concept of probability is not there. Can you see in the definition of asset, I've not mentioned probability. So the concept of probability is not there in the definition of an asset. What is the, you can say, what is the definition of asset? What is the keyword? Economic resource and control. So I should be able to control this and it will lead to inflow of economic resources. So these two are the, you can say, keywords in the definition of my asset. Now, what do I mean by income? Income is also everything good. So income is increase in asset is income. Decrease in expense or decrease in liability is income. So, and increase in equity is also income. So everything happy and good is income. Increase in asset, decrease in liability, increase in equity. So this is income. Then what do I mean by expense? Expense is everything sad. What is everything sad? Decrease in asset is expense. Increase in liability is expense. And decrease in equity is also expense. Now, can you tell me there is a difference? There is a difference between the expense definition under conceptual framework and one of our standards in SBR. If our students close your ears. So in SBR, we have one standard which varies from conceptual framework. Can you name that standard? It was there in one of your questions in Super 20 as well. Can you name that standard? Come on. IFRS 2. So in IFRS 2, when we pass a journal entry, we say employment expense debit and equity credit. This is what the journal entry that you pass in share-based payment. So here you're creating an expense where your equity is getting increased. It's getting credited. So there is a dispute. This is a dispute between conceptual framework and the standard. Now, in case of dispute between IFRS and conceptual framework, you are supposed to say standard wins because some standards, for example, IS 37, are still not revised as per the revisions in conceptual framework. So there have been revisions in conceptual framework, but a corresponding revision in the standards have not occurred. For example, IS 37 still talk about probability, but the conceptual framework, it does not talk about probability. So whenever there is a conflict, IFRS is going to win. So here also there's a conflict between CF and the standard, but again, IFRS 2 wins with or without logic. Then what is the liabilities definition? Let's talk about the definition of a liability. So it is something which is a present obligation. Okay, presently there is an obligation due to past event, which will lead to outflow of outflow of economic resources. Now, once again, these economic resources is a bigger term. Previously, we used to use the term economic benefit. Now it has been revised to the word economic resource. Correct? So this is the definition of liability. But if you go by IS 37, still the definition of provision is present obligation, which will lead to probable outflow of economic benefits. So still in IS 37 definition, resource word is not included. And still in the IS 37 definition, the probability concept is there, but in conceptual framework, that has been erased. So once again, there is a dispute, but who will win? IS 37 will win. Now, when do we derecognize our financial elements of financial statements? When should we derecognize them? We are supposed to derecognize them when the risks and the rewards, are being transferred, So that is when you actually record. So you also record a profit or loss on disposal. And if you have retained something, for example, you've just sold 60% of your asset, so 40% is still with you. So you need to record that retained asset. You need not, don't recognize or don't derecognize your retained asset. And on the basis of how much you have retained, then only calculate the profit or loss on disposal. Very good example of it would be sale and lease back. When we actually calculate the profit on disposal, we do that ROU na PV over FV into CA. So in that case, what we are considering or defactoring is we are trying to consider that we still have some of the asset with us because we have retained some portion of it by leasing it back. So even though I've disposed of my asset by the carrying amount, but still some portion of it is with me in terms of ROU, in terms of right of use asset. So that is why sale and leaseback is an example where you also cater to what is your retained component of the asset, and accordingly you calculate the profit or loss on disposal. That is it. So this is what we have from conceptual framework, which you all should revise and must know as ingredient in your case studies, especially for SBR students when you are doing your, such questions where they ask you CF mixed with a standard. So this is how you're supposed to respond. And these are the terms that you have to use. Quick confirmation from everyone. Are we guys clear on conceptual framework? I need attention. I don't need sleepiness, laziness, or any unfocused student in the class. Are we all clear on this? Yes or no? High on energy? Come on, quick. Clear? Awesome. Let's move forward. Now let's make a table of IS 16 versus IS 38 versus investment property, that is IS 40. Let's go on. So what we have in IS 16, let's take the definition. So first we'll talk about the definition part. So property, plant and equipment, this is for intangible asset. Then this is for investment property. Okay. Now PPE, what is the definition of PPE? Let's look at that. Property, plant and equipment is any non-current asset. What is non-current asset? Any asset that are used for more than 12 months is a non-current asset, right? So non-current asset, any non-current asset that is used in the process of manufacturing, that is used in the process of manufacturing, or it is used for administrative purpose, or it is used by the owner, self-use. So owner occupied property, manufacturing like a factory, administration means your office space. So all these things, owner occupied or rental, given on rent. So we'll know the difference between what is PP and investment property, but this is the definition of NCA, property, plant and equipment. Now, what is investment property? Investment property is idle property. Investment property is idle property. Investment property is the property held for just earning the rentals from third parties. Please note that word, third parties. Then investment property is held for capital appreciation. So I was doing one question with my AAA students some time ago, which is relevant to SBR students and FR students as well. So there was a property which was kept outside the actual firm. Like there is an office of a company, and outside that office, there is a property which is just like a showpiece. You know, we keep a showpiece. Now, the question was whether it's PPE or whether it is investment property. Now, can I say even if it's a showpiece, it's idle, right? Showpiece means it's idle. I'm not using it. It's just there. Its value is increasing. It was a kind of you can say showpiece only, some kind of plant you can consider, or an equipment that you can consider. But it was a non-current asset. So in that case, it becomes investment property, even if it is just in front of your office building. So that becomes your investment property. So in that case, whatever is lying idle, which is not being used for your, production process, that becomes your, like, there was a proper building thing created in front of office. So that becomes your investment property. Correct? Now, intangible asset, what is intangible asset? It's a non-monetary asset which is having no physical substance. So no physical substance, that means I cannot touch it, see it, transfer it. No physical substance. So can you touch and see the knowledge that you get from the classes? Can you actually, mold it or soak it in water and then maybe eat at night so that you remember everything? So can you just soak this video at night and, just put it in your brain? Can't happen, right? No physical substance. So this is non-monetary asset, no physical substance. And then we have that we should have a reliable measure of this thing available, and it should be identifiable. Now, identifiable means that either I can sell it separately, or the value is available, or it is arising from a legal or a contractual right. Now, if you talk about your driving license, even if it is your intangible asset, but you can't sell it. Can you sell your license to someone else? No, you can't. So in that case, it's a legal or a contractual right, and that is the reason why it is an intangible asset and not your property, plant, and equipment. Now comes the accounting treatment. So accounting treatment for IAS 16, initial accounting treatment for all the standards is constant. What is the initial accounting treatment? Initially, you record it at cost. How do you record it at cost? You take purchase price, PP. So on Instagram, when the brands are selling their products, you see people write in the comment PP, and then the brand says BM for the price. So that PP is purchase price, right? So purchase price plus you will say any directly attributable cost, which can include transportation cost to bring the asset to the warehouse, to bring the asset to the office. Then there can be import duties, which are also directly attributable costs. So directly attributable costs are added. Then present value of dismantling cost. So dismantling cost is nothing but decommissioning. So if you have seen the movie Robot, what happens there is you have a robot and that is decommissioned, that is dismantled at the end of the movie. I'm talking about the first part only. I don't know exactly if there is any second part or not. But yeah, I'm talking about that first part where actually the robot was dismantled. So the present value of that cost is included. And then what else do? We also take irrecoverable taxes. What are irrecoverable taxes? Now, for example, guys, I am GST registered, but I buy an asset from a person who's not GST registered. So I will end up paying 18% GST, right? Or maybe let's suppose I am not GST registered, and the person who is selling me the good is GST registered. So he's going to sell me something and charge me GST. But since I do not have a GST number, GST is equivalent to VAT only. Since I do not have a VAT registration, so I can't go to government and claim back that tax. So what will happen? That will become irrecoverable tax. Now, government will not refund me that tax because they're not going to consider me as a registered business. So in that case, it's my irrecoverable tax, which gets added into the cost of the asset. So this is what you do in your initial thing. That is very much constant with the IS 40 and IS 38. Then if I talk about subsequent treatment, what is the valuation method? Subsequently in IS 16, you have cost model and you have revaluation model. Subsequently in IS 38, you have cost model and you have revaluation model. Now, subsequently in IS 40, you have cost model and fair value model. Now, how to differentiate between revaluation and fair value model? Because cost model, the name is same, so the cost model rule is also same. So let's talk about cost model. So what goes into the cost model? We take the asset. Asset is taken at carrying amount. What is the carrying amount? Carrying amount is CA is equal to purchase price, or you can say the cost minus accumulated depreciation till date minus any impairment that has been charged till date. Impairment has a proper standard of IS 36. Then what is revaluation model? Revaluation model, let's talk about it. What are the rules of revaluation model? So very interesting model, still very important, mostly tested, even if I talk about financial reporting. So revaluation model says that the revaluation gain goes via other comprehensive income, and revaluation loss is first taken. First, you take the loss out, taken out of the revaluation surplus of the previous year or previous, related to that asset. So in brackets, you will just write that surplus should always relate to that asset. It should not be a surplus from something like a different asset. So if there is any surplus from previous years from the related asset, first you will take out the loss from there, and the remaining loss is taken out via statement of profit and loss. Now the question comes, what is revaluation? Revaluation is when the asset is taken to its fair value. That is what we call as revaluation. Now, when should I take the asset to its fair value? Should I take it at each reporting date? Answer is no. We should take the asset to its revalued amount at regular intervals. What is the definition of regular interval? Is regular interval every another hour? Is regular interval every month? Is regular interval every 6 months, every year? No. Regular interval is whenever the difference between the carrying amount and the revalued amount, is significant. That is when I take the asset to its revalued amount. So that is what I do for revaluation model. One last rule for revaluation model. Is cherry picking allowed in revaluation model? No cherry picking allowed. What is cherry picking? Cherry picking is that all class of assets, the whole class of asset should be revalued. Whole class of asset should be revalued. That means I'm not supposed to just revalue one plant of mine because I think it has increased in value. I am supposed to revalue my whole class of asset. So every plant of mine will be revalued because I can't cherry pick under IS 16. One last thing from revaluation model. Do you depreciate? The question is, do you depreciate under revaluation model? Do you depreciate under the revaluation model? The answer is no, big no. We do not depreciate under the revaluation model. Rather, what we do is, do we depreciate? Yes. It is the fair value model where you don't depreciate. So I was confusing you. IS 16 says that under revaluation model, you are supposed to depreciate your asset. But then how do you charge the depreciation? Depreciation is equal to revalued amount divided by remaining life of the asset. Remaining life of the asset. So please take note of it. It is the fair value model where you stop the depreciation. It's not the revaluation model where you stop the depreciation. Correct? So this is what I mean by revaluation model. Now, what do I mean by fair value model of investment property? Let's talk about that. So fair value model of investment property. So the first pointer in fair value model is that you are supposed to take your asset, take the asset, take the investment property to its fair value at each reporting date, at each reporting date. Okay. And then charge, or you can say take the fair value movement via statement of profit and loss. Take the take the fair value movement via statement of profit and loss and not via other comprehensive income, and stop depreciating the asset. So stop the depreciation process, right? So this is what we do for fair value model of investment property. Now that's it. These are the rules of IAS 16, IAS 38 and investment property. Now in IAS 38, guys, we don't charge depreciation, rather we charge amortization. What are the rules of amortization? Let's discuss them. So what is amortization? Let's write a proper write-up or a paragraph on it. Let's give a heading: amortization of intangible assets. Amortization of intangible assets. So first we'll talk about, okay, so intangible assets amortization, we'll talk about two kinds of intangible assets. There is, first kind is definite life intangible asset. So what is that? Any intangible asset whose life is determinable is amortized over its life on straight line basis. Its life on straight line basis. And then what we have is we have our indefinite life intangible asset. So indefinite life intangible asset says that we are supposed to, not, no amortization is charged on this kind of an asset, and we are supposed to do annual impairment review. Annual impairment review is conducted on such an asset. What is annual impairment review? We will learn in IS 36. Correct? So indefinite life asset is whose life cannot be determined. For example, can you determine the life of Nike? Why? Because it's been carried out since so many years. How would you know that till when it is alive? Can you determine the life of brand of Apple? No, it's going on since years. So you can't say no, it is just for 1 year, 2 year, 3 year. There's no life. But when I say, can you determine the life of TG professionals? Yes, you can say as of now. Why? Because it is dependent upon my life. Till when I am alive, TG professionals is there. So you can say there is a life attached to TG professionals. But there are some, for example, I think Chanel is also something which is based behind a name of a person. So I'm not sure. Okay, don't troll me on that. So I'm not really aware of it, but I've just heard it in one of the memes. So my source is Instagram, let it be. So I think that is named after a person, but now that person is anymore not there, but still that brand is going on. So sometimes, you have to wait and watch what is the performance of the brand. Sometimes, even without that person, that brand does really, really good. So that is something that you need to remember. Okay, let's go on. Amortization of intangible assets sorted. Now, what we need to do is one question which you might be getting that, ma'am, in IS 16 also you said rent, huh? In investment property also you said that it is rental from third party. So what is the difference between these two, right? So what do we do? Let's write it up. Let's write it up. How is the IS 16, how is IS 16 different from investment property in terms of given on rent? So what is this? How is IS 16 different from investment property in terms of given on rent? So in IS 16, guys, in IS 16, what do we do? we consider if the owner occupied property is there. So we'll say if the property is owner occupied, then it is IS 16. For example, in a house, one room is given on rent, and rest of the house is owner occupied. I would say this concept is of Airbnb or a PG, you can say, paying guest. So in that case, it's IS 16. However, let us take an example. Let us take an example where there is a 10-floor building. There was a proper question in SBR, if you remember. I think it was ZTech company, or I don't remember the name, but yeah, there was a question on this Zippy company. Yes. However, let us take an example where there is a 10-floor building, and the first floor is taken, the first floor is owner occupied, the ground, or you can say the second floor is given on rent to a subsidiary. How to treat it? How to treat it? Let's see. So you'll simply say the first floor in group accounts and in parents individual accounts is IS 16, correct? This is IS 16, property, plant, and equipment. And if I talk ahead, the second floor, however, is given to subsidiary, thus in individual accounts of the parent, individual accounts of the parent is investment property, because in individual accounts, the subsidiary is a third party. It's a third party. It is not something whom we know. So it's a third party. However, in group accounts, the second out of the 10th floor is IS 16, because it is used by the subsidiary, which actually is part of our family, which actually is part of the group, or you can say the family. So that is owner purpose. You are saying that one of our subsidiary is living in the second house or the second floor. So that exactly is becoming like it's used by our own person only. Subsidiary is our own person. So that is why the second floor will be treated as our IS 16. So that is the concept of rent that is tested in SBR widely in Zippy company question. Even for FR students, it's very important. You can be asked such question in MCQs. Sorted? Give me a quick confirmation. Are you guys clear? Let me move on to the next concept of IS 36. Are we all clear on this? Yes or no? Big yes. I need big yeses. Are we all clear? Come on. Have a glass of water. It's 30 minutes already into the session, and you guys may have been in a situation of losing the focus. So have a glass of water, just look around for a minute, and yeah, then we will continue. Yes, that's like good students. Awesome. Let's move on. IS 36, guys. IS 36. What is there in IS 36? We talk about impairment. Now, whenever I talk about impairment, now draw one emoji. This emoji is a sad emoji. IS 36 is impairment, no sad thing. So impairment of assets. Yes. So let's talk about it. Let's talk about it. What is impairment? Impairment is reduction in, okay, reduction in value of asset is what we call as impairment. Now, impairment is always given to us as an indicator. So, impairment does not, how do you know that the value of your asset is reduced? Will the asset cry in front of you and say, dude, my value is reduced? No, there will be some indicators, just like a newborn baby is born. So, the mother takes care, and the newborn baby can't speak and tell that, I am hungry or I want to go to the washroom. So, there's no such thing. So, you need to look for the indicators, right? So if the baby cries in a certain way, I was looking at one, again, Instagram is my source. So I was looking at one meme again, and they say that if the baby cries in this way, that's what he's trying to say. If he cries in that way, that is what he's trying to say. So you need to check at the indicators. You need to look the indicators. So indicators can be internal or indicators can be external. That is how we will get to know that whether our baby or the asset is impaired or not, right? So what we look for, internal or external indicator. Internal indicator example, come on, let's write the internal indicator example. That can be loss of key employees. So for example, someone who knew the running of the machinery has actually left the job, the factory. Now nobody would be able to use that machinery to its maximum, to its maximum capacity, right? So internal loss of key employees is an internal indicator. Then if I talk about any other internal indicator, loss of productivity, decrease in production capacity, decrease in production capacity. So this is basically like you are trying to say that the production capacity, for example, in 1 minute we were producing 100 products and now we are producing in 1 minute just 20 products. So that is loss of production capacity. Then external indicator. Let's talk about external indicator. External indicator can be a flood, it can be a natural disaster or any such thing. It can be a theft, it can be external indicator can be recession, external indicator can be inflation, external indicator can be loss of demand. Okay, so all these things, for example, COVID was an external indicator for impairment for a lot many companies. It was just good for online tutors, huh? I started in 2020 when COVID hit. It was very good for online tutors, but the people who were teaching offline, they had suffered a setback. And if you see now, the edtech companies are bearing a lot of losses because now the people have started again coming back to the same kind of study pattern. Right. So this is impairment of asset. So how do we record the impairment of asset once we find the indicator? Now, will indicator also come dancing to you that I am the indicator of impairment? No, you need to look for indicator, look for indicator of impairment at each reporting date. So it is your duty to actually look for the indicators of impairment at each reporting date as an accountant. Now, once you find those indicators of impairment, you are supposed to conduct an impairment review. Now, what in the world is an impairment review? In impairment review, you compare or you take lower of carrying amount. You can take a lower of carrying amount and recoverable amount. What in the world is recoverable amount? We all know what is carrying amount, but what is recoverable amount? Recoverable amount is higher of, higher of, higher of value in use and fair value less cost to sell. So what is value in use? Value in use is present value. Value in use is present value of future cash flows. Okay. And what is the fair value less cost to sell? So fair value comes from IFRS 13, level 1, level 2, level 3 input. Level 1 is highly prioritized, where we talk about quoted prices in active market. Level 2 is second priority of ours if level 1 is not available. So from level 2, we get the prices of similar assets in active market, or we get the prices of identical assets in inactive market. So that is what fair value is, right? Now in value in use, what kind of rate do you use to calculate your growth? What kind of growth rate do you use? You use either reducing growth rate or a zero growth rate. That means you keep it stagnant, that cash flows will grow by 1%. Or you say in the year one it will grow by 2%, then in year three it will grow by 1%. So either you take a reducing growth rate or you keep it constant, steady. Correct? So this is what we do for our value in use calculation. Now, what are we supposed to do? Once we have taken it, we will see which one is lower. So we will record the asset at lower of carrying amount and recoverable amount. And once you've done that, that will give a rise to a loss. And then, guys, where will this loss go? Same rules as revaluation downwards. First, you will take the loss. First, take the loss from related revaluation surplus. And secondly, you will take the loss, remaining balance from statement of profit and loss. So first, you will take the loss out of the revaluation surplus and the remaining from P&L. That is the rule for impairment. I will not dive into that reversal of impairment. Those are so much technical things. We're just revising the topics. We should know everything about each standard rather than knowing every standard in depth. So it's like no more, may not be in depth, but no more. Let's move on. Once we've done this, let's talk about the concept of cash generating unit. What is cash generating unit? It's a smallest group of identifiable assets which are capable of generating independent cash flows together. Independent cash flows together. So they cannot generate independent cash flows single-handedly. For example, if I'm teaching in this whole studio where I'm sitting right now, if there is a light in front of me and there's a fan above me, which I've put off because that creates noise, but there's a fan in top of me. So can I say that how much revenue am I generating because of this fan? I can't. Can I say how much revenue I'm generating because of the studio? Certainly, yes. Because I record the classes here, I take the live classes here. So in that case, yes, I can say that this much is the revenue which is generated because of the studio. So in that case, it becomes a CGU. I might have an office where employees are sitting. Now, that is a different thing. They are generating revenue separately. Now, this is a group of identifiable assets where the fans, the lights, the equipments, the laptop, me, okay, my intangible asset of knowledge, all these things are actually acting in, you can say, sequence to generate revenue. So CGU, that is the smallest group of identifiable, that is the smallest group of identifiable asset which are capable of generating independent cash flows together. So once you impair a CGU, the rule is how to allocate a how to allocate impairment to a CGU. So first, how do we allocate impairment? First, we allocate to the damaged asset, and then we allocate the impairment to the goodwill, which is considered as a corporate asset. Corporate asset is which is omnipresent. What is a corporate asset? It's omnipresent. For example, brand is omnipresent in the whole company. Goodwill is also omnipresent. So first you impair damaged asset, then you impair your goodwill, which is a corporate asset, which is omnipresent. Then you prorate the remaining impairment to the non-current assets on pro rata basis. Pro rata basis. So I need to first allocate it to the damaged asset. For example, in the case study they've mentioned, due to a flood, there was a damage to the plant and machinery. So first the impairment is allocated to that machinery only. And then second impairment allocation happens to the goodwill. And then lastly, I will prorate it to the remaining non-current assets. I never impair current assets. So please write a very big star point. Current assets are never impaired. Current assets are never impaired because inventory is already recorded at lower of cost and NRV. So it is already at a lower amount. And if we talk about cash, cash never gets impaired. Okay, cash never gets impaired. And then if I further talk about receivables, so receivables impairment is undertaken in IFRS 9 and not IS 36. That is the loss allowance that you create. FR students, don't know this, but yes, current assets are never ever impaired under IS 36. So it's just the non-current assets which are impaired. Are we guys clear on impairment? Come on, yes. Ma'am, if we have a patent which is intangible asset, do we allocate full impairment to it? Then rest to NCA. No, no, no. It's just to the goodwill. Patent will become another part of NC only. Yes. Are we guys clear? Come on. Let's move on to the next standard. IFRS 5. So what we have in IFRS 5? What is IFRS 5 all about? Okay. What is IFRS 5 all about? See, receivables impairment is loss allowance. Receivables impairment is loss allowance which is created under IFRS 9. Lifetime expected loss allowance is created. Yeah. So IFRS 5 is non-current asset held for sale and discontinued operation. Discontinued operation. Okay. IFRS 5 is non-current asset held for sale and discontinued operation. So what is non-current asset held for sale? What is non-current asset held for sale? It is basically if the following criteria is met, then only any asset or operation is considered as held for sale. So what is that? Caption. C stands for, caption is the criteria where C stands for commitment to sell. So management should be committed to sell. They should have an active plan to sell. When I say active plan to sell, that means that they have located the buyer and they have reasonable prices attached. So if you bought a car for, let's suppose, $1,000 and it's a second hand car, you can't resell it for $900. So you need to keep a reasonable price so that it shows your intention to actually sell that asset. So active plan. Then the sale will happen in the present condition. That means no repair. Okay. So in the case study, if they say we will repair the asset and then sell, so that means they're not selling it in present condition. So it does not qualify as IFRS 5. So present condition, I need to sell it in whatever condition it is in right now. No repair, no modification, nothing. Then what I do is sale is probable. So it's very much probable. Once again, this one is against, I can say this one is against conceptual framework because conceptual framework removed the concept of probability, but still this standard yet talks about the concept of probability. Then what else? Sale within 1 year. Okay, sale will happen within 1 year. And then no change to the plan. No change to plan. So these are the things that we need to keep in mind before we classify anything as held for sale. Now, once you've classified it as held for sale, what is the accounting treatment? So what is the accounting treatment? Let's talk about that. So the accounting treatment says that we need to record the asset held for sale as or at lower of carrying amount and fair value less cost to sell. So basically you are impairing the asset. You're not considering value in use because anyway you're going to sell it. So there's no point of value in use. So you're impairing the asset where the losses are taken to statement of profit and loss, right? And then what you do is you classify it as current asset and stop the depreciation. Stop depreciation of that asset because you should not be, because you need to do not use it. So don't use the asset. See, if you have put anything on sale, so if I want to sell my house, that's a different story. But if I want to sell a car and I keep on using it. So yesterday someone came and he wanted to buy that car and today I took it on drive with my sibling and then I just scratched it. And can the buyer still be, given an excuse that give us the same price? Because, or can you say that you're selling it in present condition? How can you maintain the present condition of any asset? You can maintain the present condition only if you stop using that asset. So if you want to sell something and you're using that something, then it is unethical, right? So accounting treatment is clear. Then let's talk about what is discontinued operation. What is discontinued operation? So discontinued operation, guys, it is it is a separate major line of business. It's a separate major line of business, either due to its geography. Okay, so either it is separate because of its geography or it is separate because of its nature. For example, if I have TG Professionals India, then I have TG Professionals Dubai. So that is due to its geography, it is different. Then if I say in TG Professionals, under the company name TG Professionals, I have a clothing brand also, I have a teaching brand also, and I have some accounting services brand also. So that is something that I can say are separate. Example, Reliance. Reliance has Geo, Reliance has Trends Showroom, which is their clothing brand. So they are dealing with so many things under the company, right? So separate major line of business means that they are uh, either different by their geography or by their nature. Then what we have is any subsidiary which was purchased with the view of reselling, which was purchased with the view of reselling. Now that is also classified as discontinued operation on the day it was purchased. Please understand this concept here. Everyone does not buy a company for the sake of creating synergies. That's the dark reality of business world. We buy companies just to make our competition die. Okay. We acquire members in our team just to make our competitors die. So in that case, if someone has purchased a subsidiary, just they want to damage it and sell it, or they have a objective. This is a business tactic. I mean, you even people, they build their companies and then they sell their companies and get a good valuation. That's a way of exiting from the business. So if a subsidiary was purchased with a view of reselling, then in that case it is treated as, from the very first day, it is not consolidated. So no consolidation line by line. Okay, so you don't consolidate it line by line, rather you separately disclose it as discontinued operation in the P&L and the balance sheet. So you show a separate disclosure for discontinued operation. So what is the accounting treatment of discontinued operation? So the treatment is same, that I need to take all the assets treatment is same as non-current asset held for sale. One thing extra is there, which is disclosure. So what we do is separately present the results of discontinued operation in SFP and in statement of profit and loss. So in P&L, you show profit after tax from discontinued operation. In balance sheet, you show assets, net assets. Like you don't show assets and liabilities separately, you show net asset. So net asset of the discontinued operation as one line item. So we show it as one line item. That is what is the rule for discontinued operation. Are we guys clear on IFRS 5? All the 320 people here in the class, are we guys clear on it? Yes or no? If you're liking this session, meanwhile, please put a like on the video as well. I don't see as much likes as I see on the chat box. Come on, be quick. Are we guys clear? IFRS 5. If an asset is held for sale and it is impaired and has the valuation surplus to, okay, if an asset is held for sale and it is impaired and has revaluation surplus, so take from, yes, first you need to take it from surplus and then to the P&L. Same as that. Clear to all? Good. Okay. Let us move on, guys. Let us move on. Those who have, like, I can see someone saying repeat. Repeating is not possible in 4 hours. So I suggest you, if you just go through the recording, you can actually, it's a live session. Why don't you just go a little behind and that's fine. Okay. Let's go to IFRS 15. So we are done with our NCA part. Let's talk about IFRS 15. So IFRS 15 is all about revenue from contracts with customers. So this is what I mean by IFRS 15. So what is the accounting treatment? What is the accounting treatment of revenue? So first of all, guys, you should know what is revenue. Revenue is the proceeds from selling the products in or services in normal course of business. In normal course of business. So that is what I mean by revenue. Now the question comes in how to record the revenue. We previously used to have IS 17 for this, but now that is not, it's being removed because it was very basic or simple standard. Now we need a complex standard where we can talk about complex contracts. So there is a 5-step approach to revenue recognition where we talk about number one is where we talk about that we need to see whether it is a contract or not. So identify the contract. So how do you know whether it's a contract or not? Contract has four, you can say, identification points. First is that it is, approved by both the parties. Approved by both parties. So it is not that it's not, you can say, forced on someone. It is approved by both the parties. And then we have, identified rights and obligations. Rights and obligations have been identified, have been identified. And then if we go ahead, after identifying the rights and obligations, we need to see whether the payment terms are settled. That means how are you going to make the payment? That has been settled. And the contract has a commercial substance. Okay. Commercial substance is there. Also, the probability of receiving the payment is there. So it is the probable receipt of the payment, probable receipt of the payment. So these are the conditions when you have to fulfill this, and then only you can say that whether it's a revenue contract or not. If any of these things are not met, then it is not a revenue contract. And we identify a contract on the date we, are about to sign it or about to record it. If you've already recorded a contract as a revenue contract, then maybe the customer says, I will not repay you. That is bad debt. That is not that I will not record it as revenue. It is your revenue only. But that is under IFRS 9. Either you will create a loss allowance or you will create a credit impairment. So this is something which we call as first step of our revenue recognition. Identify the contract. Second step is, what is the second step? Second step is about separate performance obligation. So within a contract, there are separate performance obligations. So you need to determine that as well. So how do you determine the separate performance obligation? You need to see whether they are distinct or not. So how do you get to know whether they're distinct or not? They should actually be independent. Okay. So if I'm teaching you SBR, that is independent of AAA. So we have a different fees of SBR. We have a different fees of AAA. So both the buyer and seller should be ready to buy and sell it separately, right? So that is, we, identify separate performance obligation. So you can get a question here for example, if you have seen SBR students, if you have seen ZTech company question, where you actually go and you can check it out whether the contract is actually, there's a separate performance obligation or not. You need to determine that. So I think there was an inventory zero, XY. So that is something that you determine. And even from the perspective of FR in MCQs, you guys can find this question where they will give you a case study and ask you, do you think these are separate performance obligations? So very important point. Then comes the third point. The third step, what do we have is we have determination of transaction price. So in this case, you're supposed to determine the transaction price, keeping in mind various things. For example, variable consideration. So variable consideration is recorded. I'm giving you the keyword, is recorded up to the extent it is probable that there will be no significant reversal once the uncertainty is resolved. Once the uncertainty is resolved. This is what I mean by variable consideration. So all in all, this is the stupid line of the standard which you might have to state in your case studies. If you don't understand this line, this means if there is an uncertainty, variable consideration is that I will pay you money only if you meet a criteria. Now there's a probability attached to it. Will you meet that criteria? Then only you will get that money. So if you think it is probable that you will meet that criteria, so you need to probability weigh it. You need to probability weigh it. That means you need to record the expected value of variable consideration. So that is what is there for variable consideration. Then what we have is non-cash consideration. What is non-cash consideration? So it's a barter system. Come on, it's a barter system. Let's suppose you guys say, ma'am, we don't like your thumbnails. Huh? You don't put an effort on thumbnails. I don't get the time. So we don't like the thumbnails. What we can do is we can help you after the session. We can send you a thumbnail for this grand revision. So let's do one thing. You give me some lecture of SBR, or I will make thumbnails for you, or I'll do graphic designing for you. Now that is something which is a barter system, right? So you're learning also, and you're giving the services also. Now my question to you would be that how much do you charge? What is the fair value? So what is the revenue to be recorded? First is fair value of service or good received in the barter system. So I will first ask you that how much do you charge for making thumbnails in the graphic designing? You'll say, ma'am, I am from ACCA. I just do it for time pass. I don't have an agency for like this work. So I don't know whatever you would like to pay. I've seen it so many times. So what do we do in that case? We will record, if you don't give me a reliable measure of your fair value of the services, we will take the second priority is given to fair value of services or goods provided. So that's how you record your non-cash consideration. So first you take the fair value of the goods and services received. If that is unavailable, then you will record fair value of goods and services which are provided, right? That is non-cash consideration. Then what do we have else? We have significant financing component. Significant financing component. So what happens in that case? So for example, come on. What do we have it? Significant financing component. So if what is significant financing component? If payment is received after 1 year, then that is known as significant financing component. In that case, you will today record the revenue at present value and then unwind the interest subsequently, because whenever you have present value, one thing comes along with it. The sibling of present value is unwinding of interest. So whenever I order a pizza, my sibling comes in dancing, I also need a pizza. He's not here right now, but yeah, that's what happens in every household. So that's the same thing. Whenever I talk about present value, one person comes in dancing into the picture, and that is unwinding of interest. So I will unwind the interest on the present value that I've taken. So what will be my journal entry if I tell you? The journal entry will be first I'll record at present value. So I'll say receivable debit because money will come to me after 1 year. So receivable debit, revenue credit by the amount of present value. Now you will not touch revenue. You're done with revenue, you will not touch it. Then you will say in subsequent period, what will be your journal entry for recording the unwinding of the interest? You will say revenue is not to be touched. Receivable will increase because ultimately you have to take the receivable to the actual amount that you're going to receive after 1 year or 2 years, whatever is the time frame. So what we will do, receivable debit and statement and profit and loss credit as finance income, or you can say finance income credit. So this is what we do for our significant financing component. I've discussed in very much detail because this point is very important from FR and SBR both perspective. Okay. Then you come to the next situation. So we've done the variable consideration. We've done the significant financing component. We've done the non-cash consideration. What else is there? Is there anything else I'm missing on in determination of the transaction price? Is there anything else that we are missing on to? Come on. I just forgot. Was there anything else also? Yes, deferred payment, deferred consideration. So that is significant financing component only. Consideration payable. Yes, very good. Consideration payable. Consideration payable to the customer. Payable to customer. So what is this? How can you pay something to your customer? I always give this example. So just for your entertainment, because I am sure you might have been exhausted by now. So I went to Delhi, that's the capital of India, and I took a crash course there once. Like, I don't take it offline sessions, but I just took 1 quarter's crash course there. So there were some students. I'm also not from Delhi. So I went to Delhi and I was surprised to know that we have the Delhi on the map does not look so big, how big it is. There is East Delhi, South Delhi, West Delhi, and people live outside the Delhi region as well. So they were like, ma'am, we are paying you this much for the crash course, but for the up down only, if we are coming from, there was a place in the NCR region. If you are coming from here, there is no metro available. So we will be coming by cab, and that is going to cost us a lot, and you're not providing online session for this. So that was the first time I introduced Super 20 in my crash course. So that time I realized that there were some students to whom we gave that allowance, travel allowance, because they were genuinely coming from very long or far away places just to attend the sessions and the workshop. So that's why we gave them some allowance. We reduced their fee. Now that does not mean no, they pay me X amount and then I pay them Y amount. That is how stupid is that? It's like they are giving me cash and then I'm giving them cash back in terms of travel allowance. So what I can do is cash paid to customer. What I can do for this cash paid to customer, I can treat it as discount. But there is a situation where you pay money to the customer if that customer is your supplier. So it's in real world, if there are two shops and they are, face to face, one is a grocery shop, another is a hotel. So hotel will buy grocery from the grocery shop. So hotel becomes the customer of grocery shop. But maybe the owner of grocery shop, or when they have a party, they order food from that hotel. So these two people are suppliers and customers for each other. So we might have to pay cash to our customer because we have taken a service from them. So that is treated as differently in the receivables account. So I hope you understand that how do we treat consideration payable to the customer in case it is not for services or goods received, then it is treated as a discount in the transaction price. Clear to all? Sorted with all? Are we guys clear on 3 steps of what we have done till now for IFRS 15? Okay. Let's move on to the fourth point now. That is allocation of transaction price to the performance obligation. So in that case, what we do is in allocation, we just simply allocate it on the basis of standalone selling prices of each performance obligation. We just bifurcate it, right? So that this is what we do. And then fifth point, which is the most important point, is revenue recognition. Revenue recognition. So what is there in the revenue recognition, guys? You either recognize the revenue over the period of time or you recognize the revenue at a point in time. So anything which is not OTP, is ATP. Revenue is recorded when the control, passes. Yes. So what do we have? What are the indicators of control passing? You know the indicators of control passing? Indicators of control being passed. This is something which is used in almost all the situations, even if I consider IFRS 16 sale and leaseback. So what are the indicators of controls passing? For example, the physical possession has been transferred. Physical possession transferred. For example, legalship or ownership has transferred. Ownership has transferred. Okay. Then what we can say? We can talk about the third thing as payment received. These are just indicators, not rules. Payment received. There may be bill or invoice raised. So these are few indicators of control being transferred, right? So this is what I mean by control transfer. Now, when do I record or when do I think that the control is getting transferred over the period of time? So there are three conditions. Three conditions. If any met, then the control is transferred over the period of time. Over the period of time. So let's go with the three conditions. First condition is customer simultaneously, customer simultaneously receives and consumes the benefit. Receives and consumes the benefit. So, for example, all of you are sitting here and receiving and consuming the benefit of this class. Can I, after the class, ask you, please give me back my knowledge? You still can ask me, give back our fees, but I can't ask you to give back the knowledge, right? So that is something that you are, simultaneously consuming and receiving. Then second is enhancing or creating an asset, enhancing or creating an asset, which is actually, controlled, which is controlled by the customer. So if customer has some asset and I am enhancing it, for example, construction. So one day customer has a mood swing and says, bye, Tashwita, don't come tomorrow morning. I've constructed one floor already. So can I run with like Bob the Builder and take that building away? So that example, my students who are enrolled with me, Bob the Builder example. So this is that condition of Bob the Builder, that I can't run and take away my building that I've created for my customer, because the land belongs to the customer, but the construction is done by me. So in that case, I have an automatic right to payment. So right to payment must exist. Right to payment must exist. So you need to check the contract whether you have the right to payment or not. Then thirdly, you are enhancing or creating an asset which is controlled by the customer. So customer this time is controlled, which is controlled by you, controlled by the entity, but has no use, alternate use to the entity. So for example, if I make customized products, for example, everyone on the occasion of any festival, for example, Mother's Day, Daughter's Day, Valentine's Day, you get your gifts which are customized. You add a picture of a person and you get a watch, add a picture of a person and you get some kind of table lamp, many absurd things. And that is a customized thing. Now, nobody is going to buy that picture of your friend on a clock and keep it in their room, right? So that is a customized thing, even though the control of that good is still with the entity. But if sometime you cancel your order, they will have a right to payment. You go anywhere, you got a customized thing for yourself. They have no alternative use to it. They can't sell it to anyone else. It belongs to you. You have to make payment for that. So in that case, the control gets transferred over the period of time. As in when I'm making that thing, I'm recording the revenue because I know I can't sell this thing to anyone else. So the customer has to pay for this. Correct? So this is what we have for our three conditions where the revenue is recognized over the period of time. Awesome. Let's go on. We all are clear on this. Let's see what we have. Sale and repurchase. Now, this is a new topic which was added in IFRS 15, which is literally troubling a lot of students. So I'll just brief you a little what is sale and repurchase. See, this is not a full session where anyone can see this session and think that we can just prepare on the basis of this session. There are lots of things to the standards. I'm just quickly revising these standards with you because I know by the end of this time, you guys are already prepared for your exam and you've gone through a lot of things and questions. So you know what I'm saying. So sale and repurchase. What we have in this case is in sale and repurchase, we actually have an option to repurchase. We have sold something, control has passed, but then we have an option to repurchase it back. So in that case, what we consider in that case is, it is a sale. Okay, legally it is a sale, but what is the economic substance? So what do I have? Do I have an option to repurchase? So I'll take an example. Let me just take my annotator and take an example. Let's assume a situation. This is Mr. A, and Mr. A has a house. Now he sold the house to Mr. B. Okay. So he sold the house to Mr. B and he said, I will take it back from you. I'll take it back from you after few years, maybe after 2 years. I'll repurchase it at this price. He also sets a price. Now, if he has an option to buy it, if the seller has the option to buy it, then I call it as call option. So basically, the seller, which is Mr. A, he can call for his house back. Hello, Mr. B, can you send my house back to me? I want it back. I'll pay you the repurchase price that we agreed. That is a call option. Whereas if buyer B has an option that, I don't want your house anymore, it is ghosted, take it away. So if under that contract, B has the option to give the house back, we call it as put option. Now, put option can come with a liability or without a liability. I'll explain you with a liability or without a liability. And there can be a forward as well. What is a forward or a future? That under this contract, after future or after few years, you are supposed to repurchase your asset that you have sold. So this person has a liability. He has a liability to buy it back. So in that case, what happens? Just note down. If a forward or call option is there, then it is not a sale because the control has not been transferred, as the seller can, as the seller has to buy back, or can call back for the asset anytime he wants. So this is not a sale. Then what it is? We have two situations. If the repurchase price is greater than the selling price, the price at which I will be repurchasing it after 2 years was greater than the original selling price, then we call it as a loan given. So basically, you are the seller, so it's a loan taken because you've received some money. You'll treat it as a loan, that too secured loan. You've kept your house as a security, as a mortgage. In Hindi, the word is girvi. So you've kept your house girvi and you've taken money, right? So that is when the repurchase price is greater than the selling price, you treat it as a loan, that too secured loan. Now, if the repurchase price is lower than the selling price, then we treat it as a lease. It's treated as a lease, right? That means you've taken it back, like you've given it on rent to someone and you've received some money, so you'll be repaying that. So it's treated as a lease, okay? Then comes another situation, that is put option. Just remember, either it's loan or it's lease. Don't get into dive deep into this, how a loan, how a lease. This is the rule. At this point in time, this is what you should know. Now come to the second portion, when it is put option. What is put option? It is the option to give back the asset, to the original seller. Now, if the seller has an obligation to take it back, under the contract, then we treat it as not a sale. So same rules will apply as above, What is the rule? If the repurchase price is greater than the selling price, then a secured loan, otherwise a lease. But if the seller does not have an obligation to buy back, then it is a sale. So it will be treated as a sale of the asset, and you will actually record the proceeds and you will calculate the profit or loss on disposal, because this is the only situation where it is treated as a sale. So even if there is an option to repurchase, even if there's a put option, but you do not have a liability to take it back. So I For example, I took this example. Mr. B, after 2 years, can be crying and be all messy and are requesting you, please take your house back. It is haunted. But you don't have an obligation to take it back. Then the control is passed. Come on, the control is passed. You'll say, I've sold it. I don't have to take it. No refunds. Okay. Don't give me my house back. Deal with the ghost yourself. Right? So this is what you treat it as in your IFRS 15 sale and repurchase. So this is all we should know from FR and SBR perspective from IFRS 15. Okay, let's go on. How to determine the obligation? It's always given in the contract. You need to read the contract. Whether you have an obligation or not, it will be mentioned in the contract. And in the exam, it would be mentioned. Let's move on to IFRS 16 now. Leases, guys. What is leases? First of all, you should understand that we previously had a standard on leases which gave rise to off-balance sheet leases. What is off-balance sheet leases, or what was the previous standard? So previously, the old standard gave the lessee an option to bifurcate between operating lease and financial lease. Okay. So in that case, many lessees being the lazy lad, or you can say many lessees being the lazy lad, or you call them as unprofessional, or you can call them that they were being biased, um, opted for operating lease and did not record ROU and lease liability, and were just recording the rent as an expense whenever it was due. However, you can say it was due. However, this led to some leases which went off balance sheet because many leases were of financial nature, but still no ROU and lease liability was recorded. So that is what I mean by off balance sheet leases. Then the question comes, what is the accounting treatment of the leases? What is the accounting treatment of the leases? So the accounting treatment of the leases, come on everyone. We should know initial accounting treatment. First, we should know what is a lease contract. So the lease contract, guys, is any contract where we basically have the right to substantially use the leased asset and direct its use. So right to control the asset, and we have the obligation to pay a consideration in return of that. That is when we call it as lease. So you have a proper question. I think this is something that I asked in one of my mock papers to the students who are registered with me, that we saw a question where it was not a lease because, or it was a lease or not. That was the question. For example, if you talk about hostel, so in hostel, someone can substitute your room whenever they want to, and that won't cost them anything, right? So if you're in a college and you are living in a hostel, so the warden can any day, change your room. And I'm just saying from the rule perspective that this can happen, right? So in that case, we don't treat that as a lease. Rather, we treat it as an expense. This is not a right to use the asset. That room is not yours. You can't control its use. You can't ask your friends to come in. You can't, use it to your like maximum capacity. So that is why it is not a lease. But when I talk about if I talk about an Airbnb, there, the person has booked a they have looked for a house. Let's suppose I've taken a house on rent. I look for that house. The landlord cannot change that house out of nowhere. So we won't substitute it. That's why I say it's a lease and I have an obligation to pay, and I can use the house to my maximum capacity. If I want to call my relatives at home, I can. Yes, they can put on some restrictions like don't go into this room. This is locked room, or the society closes the gate by 12 a.m. So that is a rule that does not mean that I can't control the leased asset. So that is allowed. That restriction is allowed. So this is how you determine whether it is a lease or not, right? So this is what we call it as lease. Now, what is the initial accounting treatment of a lease? Initial accounting treatment of a lease. So initially the lease is recorded like you treat an ROU, you record an ROU and you record a lease liability. So what is a lease liability? What is a lease liability? Let's talk about a lease liability. Lease liability is present value of future lease payments, and the discounting rate. The discounting factor used is interest rate implicit in the lease. That is what I mean by lease liability. Then what is ROU? Initially, ROU is recorded as lease liability plus any payment any payment received on or before the commencement of lease. So any payment received on or before the commencement of lease. That is what I mean by lease liability. And then what I have is I have the subsequent treatment. So in the subsequent treatment, what do I keep in mind is that I have to, okay, yeah. So in the subsequent treatment, I have to depreciate my ROU. So ROU needs to be depreciated. So this depreciation happens as per the standard. So you take the life of the lease as shorter of life of asset or life of lease, right? So this is what you take. And then what you have is what do you do with the lease liability? With the lease liability, you treat it as unwinding of interest is done because you calculated lease liability as present value. So whenever you calculate present value, you have to unwind the interest. Now for ROU, you also treat it under IS 16 or IS 40. That means ROU is your asset, right? That to non-current asset. Now that can be treated as per the rules of cost model of IS 16 or revaluation model of IS 16 or fair value model of investment property, dependent upon why have you taken that asset on rent. So if you have taken a house on rent and you are subleasing it, then it is an investment property. If you have taken a house on rent and you are living in it, that's IS 16. So you will subsequently apply IS 16 and IS 40 on it, dependent upon the use. So dependent upon use of the leased asset. Clear? So this is what I do in the subsequent accounting treatment. Then comes the lesser accounting. Let's talk about the lesser accounting quickly. So what happens in lesser accounting? In the lesser accounting, I specifically just talk about operating lease and I talk about the financial lease. So you all should know what is a financial lease. So what is a financial lease? Financial lease is, I'm talking about financial lease. Any lease, any lease which is taken for a substantial period of time. Okay, any lease which is taken for substantial period of time. Maybe for example, the life of the asset is 10 years and you have rented it for 11 years. So it's like you are taking it on rent for the whole life. So that's a financial lease. Then the present value of lease payments, the present value of lease payments is more or less same as the fair value of the asset. So that is like you are paying the fair value of the asset as a rent. So basically you're buying that asset. Okay. You're not you're not giving it on rent from lesser perspective. If you are receiving the rent in terms like you're getting the consideration of that asset, then it's more like you are selling the asset and not giving it on rent. Then, so there are some cases of financial lease and operating lease. What is the difference in accounting treatment? So let's talk about the accounting treatment, everyone. So the accounting treatment for financial lease, we need to de-recognize the asset and record a receivable of an amount equivalent to lease liability. So you will say financial lease means my asset is going out and I am going to get money, and that money is equivalent to the lease liability, right? So you will create a receivable out of it because I sold the asset. In financial lease, you consider that as if you have sold the asset. Then what do we do for operating? What do we do for operating lease? What is the accounting treatment for operating lease? For operating lease, you simply record the rental income whenever it is accrued. So rental income in statement of profit and loss whenever it is accrued. So this is what I mean by operating lease, right? So this is how you do the lesser accounting. Then comes the concept of sale and lease back. So what do I mean by sale and lease back? That is the question. So in sale and lease back, you see whether the transfer is a sale. So there is situation one. Situation one, when transfer is a sale. How do you get to know whether transfer is a sale or not? You need to refer to as per IFRS 15, the definition of indicators of control. I gave you those. So if the control has been transferred, we will say this is a sale. And if it is a sale, then how do you treat it? Let's insert a table that if it is a sale, how do you treat it in the books of the seller, and how do you treat it in the books of the buyer? So let's do that. I'll take both the situations in this table only. So I will say in the books of seller, seller will become the lessee because he will take it back on rent, and the buyer, person who buys it, will give it back on rent to us. So he'll become the lessor. So the situation when transfer is a sale, transfer is a sale, and second situation is transfer is not a sale. Okay. So what do you do when transfer is a sale? How do you treat it? Let's do it. Okay. When transfer is a sale, that means you have to de-recognize the asset. If you are the seller and you have sold something and that transfer is qualifying as a sale as per IFRS 15, then how would you record it? Simple, ma'am. I will de-recognize the asset. And then what I would do? I will record a receivable because I have sold my asset. But then I've also given it back on rent. Like I've also taken it back on rent, not given. I've taken it back on rent. I'm the lessee. So I'll record an ROU. How will I calculate the ROU? What is the formula? PV over FV into CA. Present value of lease payments divided by fair value of the asset into the carrying amount of the asset. So I'll de-recognize the asset, record a receivable, then I will, treat a ROU or record an ROU. I will record a lease liability, and then I will also record a profit or loss on disposal. Profit or loss on disposal of my asset because I have sold it, right? Then what I will do if transfer is not a sale? I means seller, lessee. I've sold my asset and I've taken it back on rent. If this is not a sale, if the economic substance is not a sale, then how will you treat it? Come on, tell me, how shall I treat it when it is not a sale? If it is not a sale, then what? It is treated as a loan, treated as a loan because proceeds were received. Proceeds were received. You did receive some money. So that is a loan. And the rent that is paid is treated as interest on loan. Interest on loan. So legally you've taken it back on rent. There's a sale agreement. There is a lease agreement also. Legally you've taken it back on rent only. But you are saying that economic substance is different, huh? So as per that economic stance, the rent that I'm paying is my interest on loan. Correct? Then what I will do, I will not de-recognize the asset. So keep on recording that asset. Correct? Then what will the buyer do in case the transfer is a sale? So what is the accounting treatment in the books of the buyer? What will the buyer do? If transfer is a sale, so he has purchased an asset, so he will recognize the asset. So since he has purchased it, he will recognize the asset, and once recognized, he will also record a payable because he has to pay money because he's purchased something. And then he will do his normal lesser accounting, dependent upon whether it's a financial lease or an operating lease. Then what would the buyer do if it is not a sale? He will record a financial asset because he has given a loan. So it's a financial asset. Let me take the same color. So it's a financial asset. Let us take the green color where you here I am. So financial asset, which is like given a loan, and the rent received will be treated as finance income because you've given a loan and you are getting money back on. Correct? So this is how we treat our, the normal situation of sale and leaseback. Now, when the transfer, I'm just writing two sentences and then we wind up with the lease standard. So what we do is when the transfer qualifies as a sale as per IFRS 15, then the two situations arises. One is transfer above fair value. If the transfer is above fair value, guys, please note, then it is your financial liability. That extra amount is your financial liability. And if the transfer is below fair value, then that lower than fair value amount, that balancing figure is your prepaid asset. Prepaid asset. That's it. So these are the two situations that you have to consider. Okay, that's it. That's it. Are we guys clear on IFRS 16? See, I'm doing a very comprehensive revision with you. You must understand the standards. We are making very, very comprehensive notes. All clear? Okay. 15 more minutes to go, then we will take a short break. Let us do IS 37 and IS 10. IS 37 and IS 10. All should be saying yes or no. Come on, don't be sleepy. Enjoying the session? Crying in the session? What's the update? Full of confidence, full of getting the confidence back? Is the anxiety wiping off? The notes of the class after the session, I'll put it in the description box. Don't worry. The recording of this is available right after the class. As soon as I end the session, YouTube processes the stream and it is available on the channel. Yes, all confident, enjoying. Crying in the corner. Okay. Great. Let's move on to IS 37. Let's move on to IS 37. So IS 37 talks about IS 37 talks about provisions, contingent liabilities, contingent liabilities, and contingent assets. So what are the rules attached to provisions? What is a provision? Okay. So provision is, you should know the definition of provision. It's a present obligation. It's a present obligation, which is present obligation which exists due to a past event, which will lead to a probable outflow of economic benefits. right? This is what I mean by a provision. Now, this is something which should be measurable. So there must be a reliable measure of it. Then only you record this provision. Otherwise, you don't record the provision. So there must be a, a reliable measure available. And then what we have is, once we have this, we talk about the probability. Now, what is probability? Probability usually is like, if the event is having a chances of around, you say 50 to 60%, that is something that we like, it is something like, the probability exists. More than 50% is what is I consider as probable, right? Then, okay. Let's move on. So provision is present obligation. Now that might be a contractual obligation. Okay. This might be a contractual obligation, or this might be actually contractual obligation means legal obligation. And it might also be out of a valid expectation. Okay. So I'm just forgetting that word, but it comes out of a valid expectation. If you remember that word, please put it in the chat box. What kind of word was that? Where we talk about the what kind of liability is that? Contractual obligation, where we have a legal obligation, where in the contract it is written that you have to pay this much, or the court of law says that you will be having fines. But valid expectation is where I talk about, yeah, constructive obligation. Constructive obligation, exactly. So we have constructive obligation where I actually talk about the, for example, on my website, I've written that I will plant more trees. So that is my obligation, which is constructive because that is what I've written on my website, right? So that's constructive obligation. Then what we have is, yeah, thank you, constructive obligation. Sorry, I forgot the word. What do we mean by contingent liability? I'll come to that later. But what kinds of provision do we have? Number one is restructuring. So provision on restructuring. Come on, what is that? Restructuring provision. Restructuring provision is usually created when it is unavoidable. So restructuring must be unavoidable, then only you create provision. And in general, provisions are always created when the event is unavoidable. If you say I'm making losses in the future, that is avoidable. Stop your business. You will not make the loss. So you can't create a provision on future operating losses, right? So it must be unavoidable situation. And you record the provision on restructuring at earlier of two dates. What are these two dates? Earlier of two dates. First of all, the date when it was formally planned and announced. Formally planned and announced. And when I say formally planned and announced, this must have led to a valid expectation amongst the affected party. Amongst the affected party. So if I say that, I will lay off some employees and I've informed that, I'm going to lay you off. So in that case, there is a valid expectation amongst the expected party that, or the affected party, that they will be removed. So that is something the day that you record the restructuring provision. Second is that when the restructuring has actually occurred, actually occurred. So that is, these are the two dates when you actually create your restructuring provision. And how do you create a provision? Provision is created via statement of profit and loss debit and provision credit. Very simple accounting treatment of this. Then do you create a provision on ongoing activity? Point to be noted. Provision is not recorded on ongoing activity. Ongoing activity like relocation, like retraining. We do not create provision on these events. We create provision on something which is unavoidable and which has happened in the past. Like it has already happened and it gives rise to some present obligation, and that will not be avoided in any case. Then you should know about the onerous contract. So when do you create a provision on onerous contract? Why do you create a provision on onerous contract? What is an onerous contract? It is a loss-making contract. So onerous contract, it is a loss-making contract. Provision is recorded. Provision is recorded at lower of cost of termination, cost of termination of the contract, and the cost of continuing the contract. So that is when you record the provision. Then what we have is our third kind of provision. You can talk about your redundancy provision comes under restructuring provision only. Then you have environmental provision. So environmental provision is also created because it might arise out of legal obligation, but mostly out of constructive obligation. Mostly out of constructive obligation. So this is, you have to determine that cost of reversing the damage, present value of reversing the damage to the environment. So if you say that I will actually, remove the, you can say I'll remove the effect that I've made on my environment. So for that, you need to take the cost of what damage you've done and how are you going to reverse it. And on that amount, the present value of that amount is what you will create a provision on. Right? So this is what we mean by environmental provision. And this is all that you should know from provisions perspective. You should know the definition of provision, restructuring provision, onerous contract, and know the fact that provision is not created for relocation, for retraining, and know the fact that provision is not created for future trading losses. Okay. Now come to contingent liabilities. What is contingent liability? Contingent liability is basically when we have a possible obligation. So there is no possible, probable outflow, rather it's a possible outflow. So possible obligation is like less probable. I can call it as less probable, right? I can call it as less probable. That is contingent liability. So what I do for contingent liabilities, I just disclose them in financial statements and not record. So you're not supposed to record the journal entry, rather you just give a disclosure note in the notes to accounts in the financial statements. That's what you do for your contingent liabilities. Now, contingent liabilities are also a danger item in consolidation. Remember that if a company, if you are an audit student, I saw some chat message that the student said, I'm from audit, I'm giving audit tomorrow, all the best. So, in that also we learn that no, when we conduct due diligence, when we are looking for a potential, let's suppose there's a target company that I want to buy. So I am an investor and I want to buy a company. For example, I want to invest in a business. I want to buy 60% shares of that business. So I'm becoming the owner of that company. I'm becoming the parent of that company. So I will not buy that company without doing any research on that, without doing due diligence on that. So all these big fours, they also give the services of due diligence, where the big four or any firm would actually go to the potential targeted company and they will check their financial statements and they will provide a valuation to that company. Do they consider that what amount should be paid to this company to buy the equity of this business? So that is when you value a business. So contingent liability of in consolidation, they are actually recorded. So danger item in consolidation. So just write a line. On date of acquisition, the contingent liability of subsidiary is recorded at fair value in working note number 2. So what is working note number 2? I hope everyone knows from group accounts. So that's the working note number 2, which we will discuss, right? So that is what we call as contingent liability. Now, what is contingent asset? Come on, what is a contingent asset? Let's discuss that. Contingent asset, for example, insurance claim. So contingent asset is disclosed when probable, and it is recorded when virtually certain. So when I talk about this concept of virtually certain insurance claim, so I need to check the insurance papers. I need to see the terms and conditions, whether I'm going to get this claim or not, because I don't know if if you're an Indian, you must have seen a movie, Oh My God. So that is all based upon that there was some earthquake and then there was a business harm, damage, and they were trying to take the insurance. So the foreign students might be thinking what kind of movies they make. But yeah, that was a movie, not on IFRSs, but it was a whole new concept. But basically, we are talking about a situation where insurance is not, sure short. Most of the times it's not sure short. So you can only record an insurance claim contingent asset when it is virtually certain. That means you have the probability of 95% or more that you are going to receive that money from the insurance company. Right. So this is what I mean by contingent asset. So this is IS 37. And we are done with IS 37. Let's quickly do IS 10. We've still left with 5 minutes before we take a break. So IS 10, guys, it talks about what? It talks about subsequent events. What are subsequent events? I'll just quickly give you a note. Subsequent event, it would be either adjusting event or it would be non-adjusting event. So anything happens after the reporting date can be classified as an adjusting or a non-adjusting event. Now the adjusting event, what does that mean? If it's, if there was an evidence of this event at the reporting date, at the reporting date, that means you should have looked for this. Like for example of adjusting event would be uh, inventories, inventory sold at a lower price. So you had an inventory from the previous year, and after the reporting date, few months later, it was sold at a lower price. That suggests that the NRV of the inventory has actually fallen down. So it was your duty at the reporting date to look at what was the cost of the inventory and what was the NRV of the inventory. Now, if you have not looked at it, that means it's your mistake. So, dude, that's an adjusting event. Come on, go and adjust it in your financial statements, right? So that's an example of adjusting event. Another adjusting event, what can we take? We can talk about going concern assumption. Going concern assumption. So, for example, you liquidated after the reporting date. So, previous year's financial statements, they must have been prepared at breakup value basis because this is a very material thing. So, you need to actually adjust it in your financial statements of the previous year. Then what are non-adjusting event? Non-adjusting event, come on, what are non-adjusting event? If there was no evidence, no evidence at the reporting date regarding this event. For example, fire happened, there was a theft, or you purchased an NCA, or restructuring or redundancy was announced. Redundancy was announced after the reporting date. So these are the things that we record as and when they happen. I was not supposed to see whether there will be a fire in future. So in your overthinking mode as an individual, you think all the worst things which can happen to you at midnight and you crib about it, but that does not happen in accounting world, right? There would be fire, there would be theft, or there would be redundancy. I'm supposed to look at it like from futuristic point of view. That's a budget and a forecast which we just generally prepare, but that does not impact our financial statement, correct? So that is something that we do not adjust. So what is the accounting treatment for non-adjusting event? We actually just disclose the non-adjusting event if material. If non-adjusting event impacts going concern, then it becomes adjusting. So sometimes a fire literally let your company vanish. So in that case, previous year's financially statements were your last financial statement, so you need to prepare them at breakup balance. So this is what we have for adjusting and non-adjusting event. Are we guys clear on this? Yes or no? So we are just going to take a break of another, I would say, 5 to 7 minutes. So don't ask me where is ma'am. I can't see ma'am. I can't hear the voice because we will be on a break. And meanwhile, please let me know if you're enjoying the session or not. And I'm sorry I'm not able to take up the doubts because we have to quickly cover the things like just rush it up 4 hours. We have to cover all the concepts and IFRSs. So no time for the doubts now. It's just that we are just doing a race against time. So break for 5 to 7 minutes. Let's get back to the session in 5 to 7 minutes. All the best. Have a glass of water, eat something, and come back. Don't sleep, sit straight. And I'll also be sitting straight and just have a glass of water and come. Bye. Yes, guys, audible and visible to you. I hope all of you are back from the break. Quick confirmation over the chat box. Audible, visible. Can you see me? Can you hear me? Okay. Yes, I'll be sharing this document with you after the session. Uh, yeah. So let us continue with our grand revision. So we have by now covered our non-current assets. We have covered IFRS 16, IFRS 15. So these are the standards which are from like a single entity concept of financial reporting. And then we've also covered IS 37 and IS 10. Okay. So we are going to cover as many standards as possible in the 4 hours duration. Okay. And now I will be starting with IS 12, which is deferred taxation. Right. So what is deferred taxation? Just for your because this is a concept which is like lacking in many students. So what is deferred taxation? It is basically when I talk about that my tax benefit either is a deferred, it is taken forward. For example, when I'm creating losses in my company, so I don't pay tax on my loss, right? Rather, I carry forward that loss, that tomorrow I will take a deduction of it. So if you're a loss making business today, it's your deferred tax asset. So if you have not been recording this, please record it, because initially every business, first of all, business cycle is like loss, then break even, then profit. So if you are in your loss making phase, then you are carry forwarding your losses to the profitable years where you will get some tax reduction or a tax benefit. Correct. So that is something that you need to keep in mind. Then what we have in deferred taxation is where we talk about the difference, temporary difference between accounting standard and the tax basis. So accounting standard or accounting rules are separate from the tax rules. So some expenditures in taxation are allowed and some expenditures are not allowed. For example, they talk about this thing known as how do we call it as tax allowance. So for me in my accounts, it is known as depreciation, but tax authorities just think of them as a very rude people sitting on a sofa and sipping some tea. So they call it as tax allowance. So you say, sir, my depreciation was 1 lakh, but they will say, no, we will give you a tax allowance of just 90,000. So that means you can only deduct 90,000 while calculating your taxable profit. That is what I mean by tax allowance. But then what do I mean by depreciation? We all know that is something that we deduct from our profits when we arrive at profit before tax. So this gives rise to temporary difference. This gives rise to, you can say, difference in tax that we are estimating and actual tax that we will end up paying. But then why do I call it as temporary difference? Why is not this a permanent difference? Because the tax authorities, they are also going to bring down the assets value to the the recoverable amount. We call it as the scrap value. And I, as an accountant, is also going to bring down the asset to its scrap value. So whether in the first year they want to charge 90,000 and I want to charge 1 lakh, at the end of the life of the asset, we both will charge such depreciation that the asset comes down to its scrap value, which will be same for one asset. Scrap value is determined from the market. So if market says that the scrap value is $100, then we both, accountant and the taxation person, will bring it down to 100 only. Right. So that is why this is a temporary difference. And on this temporary difference arises a deferred tax position, which might be a deferred tax asset or a deferred tax liability. So let me just quickly write down for your IS 12. IS 12 talks about, first of all, it talks about the current tax. Okay. Current tax is charged on your profit before tax, and it is either, tax, you can say there is an over provision, there was an over provision of tax, or there was an under provision. From FR perspective, you know this. What is over provision and under provision? So if you have over provided for your asset, if you have over provided your tax, for example, in the previous year, you estimated that the tax paid will be 1 lakh, but actually you end up paying 90,000. So 10,000 was over provided last year. So what I will do, I will remove that 10,000 from this year's tax liability. Because you estimate, see, my year ended on 31st March 2024. I've already estimated my tax. In fact, I've also paid advanced tax. So tax is paid after few months and you make the estimate before only. That's why under provision or over provision arises, because there might be you might have underestimated the tax or overestimated the tax, right? Then what we have is deferred tax. So what is deferred tax? I just explained you deferred tax. So I will first talk about temporary difference. Temporary difference due to due to different different accounting and taxation laws. So this gives a rise to temporary difference. If if the tax base is greater than the carrying amount, then the company will pay, the company will pay more tax today, more tax today, but lesser tax tomorrow. Yes. So that is when the TB is greater than CA. Then what do we call this as? What is created in this case? If we pay more tax today, if you study more today, you'll have to study less tomorrow. We call it as your deferred tax AC. Then if the tax base is lower than the carrying amount, then we say, then the company will pay less tax, less tax today and more tax tomorrow. So it's like you're just procrastinating. So this creates deferred tax liability. Okay, this creates a deferred tax liability. How do you calculate the deferred tax asset or deferred tax liability? It is the temporary difference into the tax rate which is given in the question. So that is what you take to calculate your DTA or DTL. Then there is a case of, which is very important from both, like from especially from the SBR perspective, unused tax losses. So the unused tax losses means that the loss generated by an entity might be carried forward if allowed in the given tax jurisdiction to get a tax relief in future, related tax relief in future, by deducting the losses from the profit before paying tax. IS 12 states that this gives rise to a DTA, that is deferred tax asset, but it is only recognized if there is a solid evidence that the future profits are available. If the future profits are not available, then you are not supposed to record this deferred tax asset. So if future profits are available against which the losses will be adjusted. So we want a future profit, and that too we need a solid evidence for it. What is the definition of solid evidence? Is it like solid, like I can touch it? No. What is solid evidence? Solid evidence is something which can be trusted upon. Anything which is like coming from a third party is more trustable rather than internally generated thing. So I can say evidences, for example, customer contracts. So you've already signed some customer contracts, or you have already received a market research report which says that you are expanding into a new zone and you will be successful there. All these things are solid evidences. What is not solid evidence? Forecasts and budgets. Forecasts and budgets are not to be trusted. So this is what we will read and apply in our case study. We will see whether we are getting a solid evidence or not. If we are getting a solid evidence, fine, go and record a DTA. Otherwise, de-recognize your DTA. That's it from deferred tax asset. These are the important things that you should know. Once again, I'm revising the concept. I'm not teaching the concept. So there are more layers to it. There is a difference. There are more layers to it from SBR perspective also, where we talk about deferred taxation and the IFRS 2. We talk about deferred taxation and leases. So those are like less likely to be coming in the paper. That's why we are not revising that, but we are revising the concept as whole. Let's move on. Let's talk about another standard, that is IFRS 9. So before I start with IFRS 9, I would first like to tell you that midway of the IFRS 9, I will ask FR students to actually not listen. Like one part of IFRS 9, you will not listen, you will put it on mute. Then I will start with group accounts. That is when you are going to come back. Okay. And after I do that group accounts portion, then you will leave the session. You'll be done with your revision. So you're just left with IFRS 9 revision, financial reporting students, and you're left with your group accounts revision. So after middle of the IFRS 9, I will ask you to just close your ears. You'll close your ears. That generally means you'll close your ears because this is SBR related part of it. And after that, once I complete IFRS 9, don't log off. Just keep a look on it that where are we. Once I start with group accounts, then you can rejoin. Okay. Let's do IFRS 9. So any IFRS student who's listening to this right now, you should focus. What is a financial instrument? What is a financial instrument? Financial instrument is any contract which gives rise to a financial asset, which gives rise to a financial asset in the books of one company, and a financial liability in the books of another company, So this is a corresponding like event. So I have one financial asset in the books of one company and a corresponding liability in the books of another company. Now, what is a financial asset? Financial asset is a contractual right. It's a contractual right to receive cash or another financial asset. That is what we mean by financial asset. And what do I mean by financial liability? It's a contractual obligation. Contractual. So word contractual is very important here. So it's a contractual obligation which leads to payment of cash or financial asset. So either your financial asset goes out or your cash goes out. Now, in case if a financial liability is settled in entities' own equity instruments, that means shares. If a financial liability is settled in entities' own equity instruments and the number of equity instrument to be issued is fixed, then what is created? You will tell me. If it is variable, then what is created? Then tell me. So if I'm settling a financial liability in terms of my own shares, like I will pay my liability in terms of my own shares, for example, a convertible debenture. So, okay, convertible debenture is not an example of it, forget it. But if you settle any financial liability by saying that I will give shares in my company or I make a share-based payment. So if it is fixed, then what it is? It is equity. Very good. Then it is treated as equity. If a financial liability will be settled in a company's fixed number of shares, then it is known as, just a minute. It is known as financial. It is known as equity. And if it is variable, then it is known as financial liability. Right? So if it is fixed, it is equity. If it is variable, it is financial liability. We have done so many questions in Super 20 questions, which were related to this concept of fixed and variable, right? So keep that in mind when you are answering your questions. Then comes the heading of financial asset. Financial asset. So in financial asset, what kind of assets do we have? First, we have debt instruments. Then we have equity instruments. So when we purchase debt instruments, that is basically when you are buying your bonds, and equity instrument is when you buy shares of a company. For all financial instruments, what is the initial accounting treatment? Constant initial accounting treatment for all financial instruments. You record them at fair value. You capitalize the transaction cost. You capitalize the transaction cost unless the instrument is kept under fair value through P&L, fair value through P&L in subsequent treatment. So if subsequently that asset is kept under fair value through P&L, then you don't capitalize the transaction cost, you immediately expense it. Otherwise, you do capitalize the transaction cost. So why I have written plus and minus? Because in case of liability, to capitalize transaction cost, you need to deduct it from the cost of the liability, from the fair value of the liability, right? Then let's talk about the debt instrument and the equity instrument. How do we treat the debt instrument? What are the methods available for debt instrument subsequently? We have three methods available. First method is our amortized cost. Second method is our fair value through OCI. And the third one is fair value through profit and loss. How do we decide between them? We have two tests. What are these two tests? So test number one, there we talk about the contractual cash flow test. That means the principal, the principal, the principal and interest payment shall be received primarily in cash, primarily only in cash. So a situation where this cash flow test is not met is convertible debenture, because other than cash, you're also getting an option to convert. So if CCF test is met, then only you see what is the business model test. So what is the business model test? Business model test is whether what is your intention. So if the intention, first is if the intention is to keep the debt instrument till maturity. That means I don't know situation is also there. Second is I don't know situation, where I might keep it, I might sell it. If it is profitable, I might sell it also. Or it is for short term. You're very sure that you're keeping this asset for short term. So which method do you opt? When do you opt amortized cost? You opt amortized cost when CCF test is met. That means you're just going to receive the contractual cash flow payments in cash only, no in kind. So CCF test is met, plus the intention is till maturity. So I'm writing TM, till maturity. When do you keep it under fair value through OCI? When CCF test is met and the intention is I don't know situation. I might keep it, I might sell it. Then when do I keep it under fair value through P&L? When the CCF test is not met, that is one situation. Or when CCF is met, but the intention is short term, ST, short term. So you choose for amortized cost method when the intention is till maturity. You choose for fair value through also. You choose for fair value through P&L when the intention is short term. Right? We all understand this concept of debt instrument. Okay, come on. Now I'm not going to explain how to make amortized cost table. You all know how it is made. It is basically opening asset plus the interest minus the cash received is equal to closing asset. Just write one small line that in amortized cost table, the interest taken is effective rate of interest. Effective rate of interest. Okay. Then come to the next portion. How do you treat the equity instrument? So let's talk about equity instrument. let's come to another topic, equity instrument. How do you treat equity instrument? Equity instrument is when you purchase shares. So either you have first method available is fair value through P&L. This is by default method. And second method available is fair value through OCI. And you only choose it when the asset must not be held for trading, must not be held for trading, and an irrevocable choice for this method was made upon designation. So if this criteria is met, then only you keep it under fair value through OCI. Otherwise, you keep it under fair value through profit and loss. Correct? Then comes the impairment. Okay. Now, impairment of financial asset is a concept of SBR. So now the students who are here from financial reporting, kindly close your ears. This is not related to you. Whatever I'm going to say after this is not related to you. You guys are happy-go-lucky. You just have this much. You need to just memorize this much. Forget about all other things. So all the SBR students, pay attention now. Equity instruments we've done. Now let's talk about impairment of financial assets. So what is financial asset? We've already covered. Now we're going to impair it. When I impair my financial asset, what kind of assets can be impaired? Just make a tutorial note for you. Only the debt instruments are impaired. That too, which are kept under amortized cost and fair value through OCI are impaired. Right? Only these are impaired. Then what we have is we need to know that we need to create a loss allowance. So how do you impair your financial asset? Let's talk about debt instruments which are kept under amortized cost. How do you impair them? So you need to know the concept of loss allowance. To know the concept of loss allowance, you should know some terminology. What is that terminology? First terminology is what is a credit risk? What is a credit risk? Credit risk is risk of non-repayment, that the person won't repay us. That is the credit risk. This will create a credit loss. What is a credit loss? Credit loss is difference between the contracted and the expected amount to be received. So what is written in the contract? How much money will you receive versus what you expect to receive? That is credit loss. And how do you create a loss allowance? How do you create a loss allowance? When credit loss is taken to its present value and is probability weighted, that is when we call it as loss allowance. Now, there are two kinds of loss allowances. One is 12-month expected loss allowance. So what is 12-month expected loss allowance? This is created when the credit risk has not increased significantly since inception. So since inception, it has not increased significantly. The credit rating is good. So in that case, you just create 12-month expected loss allowance, where you just think what all bad things can happen to this company in the coming 12 months, right? Then what is second thing? Second is lifetime expected loss allowance. Lifetime expected loss allowance. So what happens in lifetime expected loss allowance? You are supposed to create this. You're supposed to create this allowance when the credit risk has increased significantly since inception. So if you think it has really increased, how will you get to know this? You need to apply your professional judgment in the case study, okay? So you need to maintain that skepticism while reading the question. Then only you'll be able to figure out whether it has increased significantly or not. Such words will be there which will indicate that yes, it has increased significantly. Then one tutorial note for you, star point for you. For receivables, always lifetime expected loss allowance is created. Now, again, I'm not teaching this standard from the scratch. So a quick revision between what is credit impairment versus loss allowance. So you will say in credit impairment, the prospective interest on debt is calculated on the net amount. That means after deducting the loss. And in loss allowance, the prospective interest income is calculated at gross amount, right? It is calculated at gross amount. So one, you are calculating at net amount. In the second, you're calculating it at gross amount. Then how do you record your loss allowance? What is the journal entry to record loss allowance? You say statement of profit and loss, debit, loss allowance, credit. And then another point that you need to keep in mind is that if an originally credit impaired asset was purchased. So when you purchase a credit impaired asset, that basically means it was already impaired. That means the person has already informed. If you're buying a debt instrument, that means you're giving loan to someone. So that person to whom you're giving loan is himself saying that I won't be able to repay this loan. But still being the stupid person, you are actually paying that loan to him. And that is originally purchasing a credit impaired asset. So in that case, what we do is we calculate the interest income is calculated by using credit impairment adjusted rate. So credit impairment adjusted rate, that is CIAR, right? You need to use CIAR. Once again, this was one of the questions in our Super 20 in SBR. We've already done this. Now come to the next concept that, okay, what happens when you are creating a loss allowance on debt instruments which were kept under fair value through OCI? So impairment of debt instruments kept under fair value through OCI. So here what you do is you actually, please understand the event which is happening here. The debt asset is already taken to its fair value at each reporting date. With the gain or loss being reported to statement of other comprehensive income. So if such an asset is impaired, then this is not for FR. So if such an asset is impaired, what happens? If such an asset is impaired, then the fair value loss has been taken to OCI. Now IFRS 9 states that the asset must never be taken to an amount lower than its fair value. Therefore, the fair value loss which went via OCI has already within it, the component of loss allowance. So that loss allowance is already within that fair value loss, which has already gone to OCI. So if there was an asset of $100, whose value, whose fair value at reporting date was dollar 50. So the loss of 50 went to OCI. If in question if in question it is written that on the same asset, a loss allowance of $30 is required, then it is assumed that the initial $50 loss has 30 within it. It is not the 30 is not an extra, right? The 30 is not an extra loss. So what we have is, what we will say, thus, out of $50 loss, 30 will go via 30 will go via statement of profit and loss as loss allowance, and the remaining 20 shall go via OCI as fair value movement. That's it. So this is the concept of debt instruments which are being impaired, but these debt instruments were kept under fair value through OCI. Nobody really explains this so much in detail that I've done in a revisionary class. So I hope that you guys understand this concept clearly, crystal clear. Even if you have seen this for the first time, it should make sense to you with the help of the example that I've taken. Okay. Now let's move on, guys. Let's move on to our derivatives. So let's talk about derivatives. So what happens in derivatives? What are derivatives? Three conditions needs to be met to be called as derivative. First condition is that the value is dependent on an underlying item. And second, it is settled at a future date. Lastly, it is you can say has zero or less initial value. Then there is a concept of whether a non-financial item or a non-financial asset or liability be considered as a derivative, then you would say yes, it can be considered as a derivative only if it is settled net in cash. Right? So either you are settling it in net in cash as given in the contract, or you take the delivery of that asset and then you immediately sell it and you get cash, or that non-financial asset in itself is a highly liquid asset. So this is what we mean by derivative. Then what is derivative accounting? Derivative accounting is simple, that I need to keep the derivative using fair value through P&L approach. That means I will say derivative recorded and P&L debit or credit based on whether the derivative is favorable or unfavorable. So favorable derivative is known as a financial asset and unfavorable derivative is known as a financial liability. Sorted. Now let's talk about hedging. Let's come to the concept of hedging. Favorite topic of all the SBR students. You all love it. I know you don't say it, but you love it. Hedging. So what is hedging? We need to first understand that the hedging rules only apply if the hedge is documented and the hedge effectiveness criteria is met. What is the hedge effectiveness criteria? First is, see, I'm just revising, so I'm not going to explain you, but I'll just type those hedge effectiveness criteria for your revision. So what is hedge effectiveness criteria? There is an inverse economic relationship between the hedging instrument and the hedged item. So that basically means that if the value of one thing is increasing, then the value of another thing is decreasing. Then only you will net off the gain and the loss of the two items, right? So if one person is, low phase, another person has a high phase, so he'll be able to support that person who's in the low phase. So that is why hedging instrument and item should be inversely proportionate and dependent on one underlying item. So there's an inverse economic relationship. Second is, what is the second point of hedge effectiveness criteria? That the credit risk, credit risk should not dominate the fair value of the hedged item. So credit risk should not dominate the fair value of the hedged item. That means if you have any receivable or payable that you are hedging, so by buying a forward or a future, you're hedging your foreign receivable or payable. So in that case, you're supposed to make sure that this receivable and this payable, the credit risk is not impacting the fair value or is not dominating the fair value movement of that receivable and payable. And it is just dependent on the underlying item. Okay. Then the hedge effectiveness or the hedge ratio should be effective. Should be effective. So if these criteria are met, then only we say that this is a hedge and hedging rules shall apply. Now, in this case, there are two types of hedges. One is cash flow hedge, another is fair value hedge. So the rules of cash flow hedge. In cash flow hedge, the item and instrument both are taken to their fair value at the reporting date, with the gain or loss being reported to other comprehensive income. Then we need to see what is the effective portion and what is the ineffective portion. So the ineffective portion, what is ineffective portion? If gain on instrument if the gain on instrument is greater than the gain on item. Remember that sibling example? So, what was that example? I am the younger sibling at my house. I have an elder sibling. So I was born and brought up just to entertain my elder sibling. So he was getting bored, and my parents thought there's no kid to play along with our elder kid. So let's bring on some younger child. So I was brought on, and I think elder sibling has this, or the younger sibling has this life low key. You won't accept it, but somehow that's true. So the younger one is just brought into the world to entertain the elder one. Now imagine the younger one troubles the parents more, or it troubles the parents more than the elder one. Now, won't the parents say, dude, you were brought into this world just to entertain your elder brother or sister, and you are troubling us more? So you are an ineffective portion. You are an ineffective child. So sorry for being that brutal, but basically I'm just trying to explain a concept here, that the financial, in case of hedging instrument, that instrument was brought just for the hedged item. So the hedged item's value has not fluctuated that much as the instrument's fair value has fluctuated. So the extra fluctuation in the instrument is known as ineffective portion. Now that goes via statement of profit and loss. Correct? So this is what I mean by cash flow hedge. Remember this concept. You might forget this concept, but please remember this with the example of elder and younger sibling with no due offense. Okay, please remember this with the example of elder and younger sibling. You will never forget this concept. That's my guarantee. Move on to the next one, fair value hedge. What do we have for fair value hedge? We simply say that the hedged item and instrument both are taken are taken to fair value, and the fair value movement goes to statement of profit and loss. Only one exception is there, unless the item is an equity instrument kept under fair value through OCI. So there's only one exception to fair value hedge when the hedged item is an equity instrument which was kept under fair value through OCI. Then only I will take that fair value hedge gain or loss via OCI. Otherwise, it goes via statement of profit and loss. Clear to all? That is the end of hedging topic as well. So if you know this much from the hedging, kudos, you've covered hedging. No need to worry. No need to do anything extra on this. This much is enough. Lastly, we will just discuss what do we mean by financial liabilities. So these were all financial assets now. So what about financial liabilities? How do we treat financial liabilities? So financial liabilities, guys, what we have in here is we talk about in financial liabilities, we have two methods. One is amortized cost, which is by default. And we also have the fair value through P&L method. When do we opt for fair value through P&L method? When the liability is held for trading, or when the value is held, when the liability is held for trading, or to avoid an accounting mismatch. How can you avoid an accounting mismatch? I'm just giving you a brief. See, all these concepts that I'm talking about here, I've also revised these concepts in the podcast on Spotify. So if I would request you also to watch that, just search IFRS with TG on Spotify and you'll figure out me and you can just listen to that podcast. So fair value through P&L, when it is held for trading or to avoid an accounting mismatch. So what is accounting mismatch? For example, you bought company A, bought an investment property by taking a loan. So if I bought an investment property by taking a loan, so that investment property is kept under fair value model, fair value through P&L. So we say that the loan was also introduced into the accounts together with that investment property. So that investment property is kept under fair value through P&L. So that loan should also be kept under fair value through P&L. So to just few companies does that. That is based upon judgment. Once again, very rare situation. And in that case also we see if the fair value movement is due to the credit risk of the business. Credit risk is because this is your liability, so your credit risk is factored here. So the fair value movement which happens because of entity's own credit risk, that goes via OCI and the remaining goes via P&L. So this is what we do for financial liabilities. Lastly, from IFRS 9 that I want to revise is convertible debenture, so that you also remember them. Convertible debenture. So convertible debenture, when they are issued, we do split accounting. So it is split between the financial liability and equity. Okay. It is split between financial liability and equity. And while calculating the financial liability, you take the present value of future cash flows, present value of future cash flows, and that while calculating this, you use an interest rate. Which interest rate do you use? You use the interest rate of similar bonds without conversion option. Similar bond without conversion options, right? This is the interest rate that we use. And then one last, executory contract. What is executory contract? So in IFRS 9, you will be asked this concept. So what we do here is we are supposed to talk about when we take the delivery of an asset. That means we use that particular asset for our own use. So if you are entering into a contract which seems to be a derivative, for example, in future, I will buy wheat or I will buy electricity. Electricity is not a financial asset. It's a non-financial asset. So why are you buying electricity? Are you betting on it? Are you speculating on it? Or you want to use it in your business? So if your purpose is to take the delivery and use it for your business, then it is not a derivative. It is not a derivative. So it is out of the scope of IFRS 9. Scope of IFRS 9, rather, it is an executory contract. It is executory contract which will be settled at a future date, right? So this is something which we need to keep in mind for SBR solely. This is not related to FR. Correct? So this is what we have from our IFRS 9. And now I will end the IFRS 9 and move to group account. Someone call the FR student. So if you have muted yourself, or sorry, muted me, not yourself. So if you have muted me, and I would request you all to come back, because now we are going to start with our group accounts finally. So we're going to start with group accounts. Come on. Let them all unmute. Group accounts, group accounts. It feels like I'm standing on the bus stand and saying group accounts, group accounts. Because then FR students, how would they come to know? They have joined or they've left? Participants have actually decreased. So I hope everyone is here now. FR students join. Yes, Shruti did the best job. That's application of brain, which I am not applying. I should have written it on the chat box now. How simple. Anyways, let's start. Group accounts. So what we need to know from group accounts is that what is the definition of control. So I will just know that what is the definition of control, because if I have control, then only the parent subsidiary relationship exists. So what is control? Control is only if three conditions are met. What are these three conditions? The condition number one, that I have power over the investee. Power over the investee. How can I have power over the investee? When I have right over variable returns of the investee. Variable returns of the investee. That means I have a share in their profit and losses. I am with them within their bad times and good times also. Right? And then I have ability to affect those returns. So by taking, part in annual general meetings, I actually have the power to impact their profits. So I am going to make key operating and financing decisions, and I will impact the profit of the subsidiary because I am the parent. That is when you call that what? It is your control situation, and you have a parent and a subsidiary relationship. Okay. Now, once you have control, is it always that, ma'am, what is control? We know the definition theoretically. Is it always that if we have more than 50% of voting right, we call it as control? So, question is, what are the situations? What are the situations where control might exist, where control might exist even if the 50% voting right is not there. So the control might exist in following situations where you appoint majority of board of directors, right? Where you actually have some contracts, signed with with rest of the investors, with some investors, that you can vote on their behalf. So you have some contract signed. So maybe there are busy people and they're not joining annual general meetings. So you have potential, like signed a contract with them, or you have potential voting rights. That means you have some share options with you, which you might exercise in future. So in that case, you will get more shares in this business. Then what else can be there? Potential voting rights, of course. And then we can talk about the scattered. Rest of the investors are very small and scattered. So in that case also, keep we will keep this in mind, that we still have the control, right? Then what we do is, what is our basic preparation or basic rules of consolidation? Rules of consolidation. So in rules of consolidation, first of all, add up everything at 100% as if you own everything, right? Add up everything as if you own everything. Second is eliminate intra-group transaction. eliminate intra-group transaction, and then not just transaction, but also the balances. And then what? Show up to the extent, show up to the extent, the control is show up to the extent you don't own the subsidiary. That is basically your NCI. Show NCI, right? This is what you do. These are the rules of consolidation. Now, keeping these rules of consolidation in mind, you have 5 working notes. Working note number 1. First of all, you need to talk about the group structure. Now, usually it is difficult to identify who is the acquirer. So in that case, we need to see who is the bigger company, which company has issued shares, or which company is paying cash. So that company is acquiring the subsidiary. So you need to consider the group structure, who's the parent, who's the subsidiary, and who's the associate. This is the time pass working note. I'm talking about group statement of financial position. So give a heading. Just before we start this, let us give a heading. Group statement of financial position. Then our working note number 2. So working note number 2 is fair value of net assets of subsidiary. So we take the fair value of net assets of subsidiary at the date of acquisition. Then we take the net assets at the reporting date. Then we take the post-acquisition movement. And we have a lot of net assets of the subsidiary. So you take the net assets at the date of acquisition, then at the reporting date, then you see what is the post-acquisition movement. So the reporting date minus date of acquisition balance, that gives you the post-acquisition movement. So here, what we have is, we have share capital of the subsidiary. We take the share capital of the subsidiary. Then we take the share premium of the subsidiary, right? All the reserves. What else do we have? We have the retained earnings. We have revaluation surplus. All these things are here. Then what we have? We also have fair value adjustments. So fair value adjustments, for example, remember in IS 37, I told you that subsidiaries contingent liability is recorded in working note number 2. So this is the working note number 2 that I was talking about. So I need to record that subsidiary's danger items. So what are the danger items which are recorded here? Danger items are internally generated brand of subsidiary, which was not recorded in individual accounts, is actually recorded here. And then secondly, what we do is, after internally generated brand, also the contingent liability of subsidiary, which was just disclosed, is recorded in working note number 2 on acquisition. So here you record those danger items, correct? Then you have fair value adjustments, which happen at date of acquisition and reporting date. And then you have some additional depreciations as well. And then you also have additional depreciation just impacts the reporting date column. It does not impact the date of acquisition. Then we also have, let me just add one more. We also have PORP. When is PORP adjusted here? When subsidiary is the seller. That is when the PORP is adjusted here. So it is removed from the, PORP is removed here so that we can show its impact on working note number 4 and 5 simultaneously. So PORP is adjusted here when subsidiary is the seller. Then comes working note number 3. So the working note number 3 talks about goodwill. So what is the formula to calculate goodwill? Fair value of consideration paid, which might be a cash consideration, which might be a deferred consideration. Okay, deferred consideration is taken at present value, on whom you unwind the interest, which might be a contingent consideration, which might be a share for share exchange. So whatever it is, you actually take the fair value of consideration paid to actually acquire the subsidiary. Then you take the NCI's value. Now, NCI can be at its fair value. It will be at fair value if you're calculating full goodwill. So if you're calculating full goodwill, it will be at fair value, or else it will be at cost if you are calculating partial goodwill. So you take the fair value of the goodwill in case of full goodwill. Otherwise, you take cost if you're calculating partial goodwill. So fair value of consideration plus NCI minus the fair value of net assets of the subsidiary at date of acquisition, which is once again coming from working note number 2. This gives you goodwill on date of acquisition. And then from this, you deduct the impairment of goodwill. You all know when CGUs are impaired, impairment is allocated to goodwill also. So you deduct the impairment and you get goodwill at reporting date. Goodwill at reporting date. All the SBR students, just for you, in SBR, you know, just SBR concept. There is one concept related to proportionate goodwill. That is the concept of total notional goodwill. So when you have partial goodwill with you, you are supposed to calculate total notional goodwill. When you have partial goodwill, you need to calculate total notional goodwill just to compare the carrying of the CGU with the recoverable amount. So how do you calculate this total notional goodwill? You just gross it up. You say if 80% of the goodwill is this, 100%, how much it would be? 1% would be how much? Then 100%, how much it would be? So you gross it up. And then you gross it up, and then compare the recoverable amount of CGU with carrying amount of CGU. Correct? So this is something that you need to keep in mind. Okay. Then what we have, if let's now for all the students, okay, not just SBR, FR students also, in proportionate goodwill, impairment is just allocated to parent and not NCI, right? Parent and not NCI. Then in full goodwill, what happens? Do you allocate the impairment? Yes. In full goodwill, allocation of impairment happens to both parent and NCI in their proportion. So it is allocated to both of them in their proportion. Correct? So this is what you need to keep in mind for working note number 3. Then let's talk about working note number 4. Let's talk about working note number 4. So working note number 4 is related to our NCI. So NCI is calculated whatever value you took in working note number 3, take that value, add NCI's share in post-acquisition profits, right? Then what you will do, deduct NCI's share in goodwill impairment. This only happens when you have calculated goodwill on full goodwill basis. That gives you NCI at reporting date. Then if you have paid any dividends to NCI during the year, so even that is deducted from here. Dividends paid to NCI, that is also deducted. Then you have working note number 5. Group retained earnings. So how do you calculate group retained earnings? You take parents 100%. So we take parents retained earning 100%. We then add parents share in subsidiaries post-acquisition profits, like the movement is taken from working note number 2. So we take parent share in that. We deduct from it any unwinding of interest if that is happening. We deduct PURP from here. That is arising because of an intra-group transaction. So we deduct the PURP from here in case it is like when the parent is the seller, we deduct it from here. And then what we have is, for example, if there is any goodwill impairment, so even that is deducted, parent share, only the parent share is deducted, right? Then what else can be here? Apart from this, any provision if it was created, if any provision was created, even that is deducted. That's a loss. So that is also deducted. Then this gives you group retained earnings. If there was a gain on bargain purchase, that means a negative goodwill, that is actually added. So gain on bargain purchase, that is added, right? Gain on bargain purchase is actually added. Okay, that means negative goodwill. Negative goodwill is a very rare case. So first you need to check, maybe you made a mistake. That's why the negative goodwill is arising. Otherwise, since you've made a good bargain, you've purchased the subsidiary at a lower price. So that means you've made a good bargain, and that's a gain which is added to group retained earnings. Clear? This is how you make the 5 working notes. Fine. So that is my group statement of financial position. Then comes, how do we treat with intra-group transactions? How to deal with intra-group transactions? How to deal with intra-group transactions in group statement of financial position. So when parent is the seller, first situation is parent is seller. So if parent is the seller, you will pass a journal entry which will say, because parent has recorded extra profit, so we will say group retained earnings debit and inventory, group inventory credit. So you will calculate the PURP. How do you calculate the PURP? PURP is calculated on the basis of whether it's a markup or whether it is a margin. So margin is always on cost. Sorry, markup is always on cost and margin is always on selling price. So this is on cost and this is on selling price, right? So this is what we need to do. Then what is the next? Second is when subsidiary is the seller. What do you do when subsidiary is the seller? Subsidiary is seller. So here what you simply do is you pass a journal entry where you debit your working note number 2, where you effect your movement of fair value of net assets of the subsidiary. So working note number 2 debit and your group inventory credit. Now automatically see what happens. Working note number 2, the post acquisition movement goes to NCI also and GRE also. I took it by the share of parent in GRE, working note number 5, and I took it in working note number 4, this one by NCI as percentage. So automatically, if I'll make an adjustment to working note number 2 over here, that would further impact my NCI and group retained earnings. So another substitute entry for it is, or you can pass a journal entry, NCI debit by their percentage of PURP, GRE debit by their percentage of PURP, and group inventory credit. So this is what you can do for your intra-group transactions. Clear? Sorted? Then comes the next concept. Let us do the next concept of group statement of profit and loss. So group statement of profit and loss. What happens in here? So first thing you need to know is that all revenue and expenses of the subsidiary are recorded as per the time apportionment. So if it was purchased midway in the year, so you will only record the revenue and the expenses for, you will just record the revenue and the expenses for half year for all the subsidiaries, right? And then secondly, what we would do, all revenue and expenses of the subsidiary are recorded as per the time apportionment. Second thing is how to deal with the intra-group transactions in group statement of profit and loss, how to deal with them. So first thing, how do you deal with it is you remove the intra-group sale from group revenue, and then you remove the intra-group sale from COGS. So that is basically reducing our purchases, and at the PURP in COGS. So this is what you do for your group statement of profit and loss. Correct? And lastly, one thing that you should always remember from group statement of profit and loss is, let's see. So last thing that we should all remember from group statement of profit and loss is basically that, you know, NCI, how to calculate NCI in case of P&L. So NCI share of group profit should be calculated as a separate working note by taking the profit of subsidiary as a base. So you will take the profit of subsidiary as a base, and then you will just keep on actually making adjustments to that as per what is given to you. For example, if the subsidiary's profit is adjusted, maybe because of goodwill impairment, subsidiary's profit is adjusted because of an intra-group sale where the subsidiary was the seller. So you will adjust all those things in the NCI working note, and then you will show your NCI share in the group profit. So this is all that you need to remember from group statement of profit and loss. Please tell me, are we all clear on this? And for the FR students, we are done. We are done and dusted from the FR perspective. So are we all clear on group accounts basics? Yes, this is all which is there in FR. Lastly, from associate, you should just know one thing last. Associate, IS 28. So let me talk about IS 28, associate accounting. So associate exists only when there is a significant influence, and significant influence exists when there is a power to participate. Okay, usually between 20 to 50%. 20 to 50% is what we call as associate. And then how do we treat it? In group statement of financial position, we show cost of investment in associate. So we follow the one line accounting. So equity method of accounting is followed. And in group statement of profit and loss, we basically just show share of profit in associate. So these are the two things which happen in P&L and balance sheet with regards to associate. Okay. That's it. So these are the things that I wanted to discuss, and I hope everyone is crystal clear on the part that we have already discussed. Yes, all sorted? Clear, thumbs up. High on energy, don't get low, just few more minutes to go and we will be done with SBR also. So all the FR students, guys, all the very best for your exam. I hope this session up till here was helpful to you to revise your NCA, IFRS 15, 16, IFRS 9, and even IS 12, and also your group accounts. So I hope you guys were helped. And all the best. May you all bless you all and you all pass with flying colors. So that's it for the FR students, SBR students. Hold on tight. We are still yet to go with many more things. Okay. Let's move on. Now let's talk about from SBR's perspective solely. Okay. Let's talk about change in group structure. Change in group structure. So what do I have in change in group structure? We all need to understand this. So it's like that meme where Tom is going up the heaven. So there is a staircase. Remember my drawing in the classes? There is a staircase and Tom is going up the heaven. So this is step acquisition. When he comes down from the heaven, it's step disposal. And this is the golden door of control. So once he passes this golden door of control, I say that I have control. So I'm the parent now. Below this, below 50%, this is 50% share. Below 50%, what I have is I have no control. Here I have control, right? Then what do we have? Let's move on. Let's talk about situations. So the first situation here is situation number one, no control to control, step acquisition. So when you move from no control to control, that means you need to calculate, first of all, you need to calculate your goodwill on acquisition. Just remember, in this formula for goodwill on acquisition, keep in mind that you also need to take into account fair value of previously held interest. So you already had some interest now. Maybe you moved from 20% to 60%. So 20% was already there. So take the fair value of that previously held interest while calculating the goodwill. Correct? And then what do we do is rest all things are same as IFRS 3, where we consolidate, where we actually look at the consolidation on line by line basis. All the assets and liabilities are consolidated. Same processes followed. When we move from step acquisition, control to control, what happens in that case? Step acquisition. So in this case, NCI reduces because you are buying more shares. So previously you had 60%, so NCI was 40%. Now you've purchased 20% more shares, so NCI has come down to 20%. So NCI reduces. So how do you pass the journal entry of this reduction in NCI? You say, since I have acquired, so that means my NCI is reducing. So NCI debit, bank, that means money is going out. So bank credit, and the balancing figure goes to OCE. So this is the balancing figure, right? So this is the journal entry you pass. Then how do you calculate the percentage? Percentage decrease in NCI? You use the unitary method. How do you calculate it? You say what was the NCI at disposal date, and percentage of it was 40%. Now, what would be the NCI at 1%, right? What would be the NCI at 1%? And then you will calculate what is NCI at 20% change, because NCI is changing by 20% now. So you calculate the change. So you use basically unitary method. So NCI at disposal date is kept as base, and then unitary method is applied to calculate percentage decrease in NCI for above journal entry. Then is the situation, next is the situation of step disposal, where I move from control to control. Now, this is the case of disposal. Above one was the case of, okay, the above one was the case of acquisition. Just a minute. Yeah, the above one was the case of acquisition. Now I'm talking about the case of disposal. So let's see what will happen there. Control to control, same thing will happen, but this time the NCI shall increase. NCI increases. Once again, what is the journal entry? Bank, money comes in, NCI increases, NCI credit, and the balancing figure goes to OCE. So this is the balancing figure. So this is what you need to memorize from the third situation. Then the fourth situation, guys, is when I move from control to no control. Control to no control. So in that case, I'm losing the control of the business. This is very much asked in the questions. So you should remember this. What I should remember from here is I need to calculate, first of all, I will stop the consolidation. Stop consolidation process. You need to calculate profit or loss on disposal. So one profit or loss goes into individual accounts and one goes into group accounts. So how do you calculate that group profit or loss on disposal? For that, what you basically do is you will simply apply that happy sad rule. So you will say, what are the proceeds received from selling the asset, the subsidiary? That's a happy thing, right? So whatever is received, add that. Then in that add, what are you happy about? You're happy about that there is still some retained interest. So fair value of retained interest, correct? So you're also happy about this. So add that. Then you're also happy about fair value of NCI at disposal date because it was a headache. So you are very happy to lose this as well, right? So add that. From this, what you will do is you will deduct the goodwill of subsidiary at date of disposal because you are sad about it. You are sad about this, right? It's going out now. And then from this, you will also deduct fair value of net assets of subsidiary at disposal date. So you are again sad about it. Why? Because that fair value of net assets is going along with the subsidiary. So this will give me in total how much I am happy and how much I am sad. So total will actually be group profit. Total would be group profit or loss. Profit or loss. So either you would be happy net or you will be sad in net. Correct? That's it. So this is the formula of group profit and loss on disposal. Are we guys clear on this? Quick confirmation, all sorted? And for that, we end our change in group structure. Correct? We end our change in group structure. Now let's move on to foreign exchange and then lastly cash flow. So group foreign exchange, group foreign exchange. What we have here is what you need to memorize is that in individual accounts, when I apply this concept as per IS 21, what I do is fair value of NCI is deducted as per textbook. No, it is added. Please check your textbook. NCI is always added. No, NCI is added. It's a headache to you, no? Apply your concept. NCI has a credit balance. Now it's going out, so it's getting debited. So we are happy that this liability is going out. Okay, individual accounts as per IS 21. So here what we are supposed to do is what are monetary items in our balance sheet and what are non-monetary items as per the balance sheet. So any foreign balance that we have is basically which has a monetary item will be taken. Monetary item will be converted at reporting date using the closing rate. Now, if we use the closing rate, this will give a rise to an exchange difference, and that exchange difference shall go via statement of profit and loss, correct? Then what I have is parents account, group accounts. Let's talk about group accounts and foreign exchange. Group accounts. So what happens in group accounts if we have a foreign subsidiary? So if the parent's functional currency, you all should know what is functional currency. This is a direct question which can be asked. Functional currency is the currency of Functional currency is the currency of primary economic environment, where I talk about in which price, in which dollar or currency, not dollar, in which currency my selling price is quoted, and in which currency actually I am charging my direct cost, in which currency my competitors are working, in which currency I'm taking loan. So all these currencies are functional currencies. So first you need to see if the functional currency of the parent is equal to subsidiaries functional currency. Then what happens is the above rule applies. The above rule applies. That is of monetary, non-monetary, and exchange difference going into P&L. But if parent's functional currency is not same as subsidiaries functional currency, then what happens? Then we are supposed to determine the subsidiaries functional currency. And then if we say that subsidiary is, first of all, if subsidiary is dependent on the parent, then all the time parent functional currency is going to be equal to subsidiaries functional currency. But if subsidiary is independent and it has a different functional currency, then what we do is we will retranslate the financial statements of subsidiary at each reporting date to the functional currency of parent. So this is an extra process that you will have to do. So how will you retranslate? You will retranslate all assets and liabilities will be retranslated at closing rate, and then all income and expenses will be retranslated at average rate. And this will give rise to an exchange difference, which we call as retranslation reserve. We call this as retranslation reserve. So retranslation reserve is going into other comprehensive income. Is it ever reclassified to P&L? Yes, it is reclassified. So retranslation reserve is reclassified into statement of profit and loss when the subsidiary is sold. So we do reclassify the retranslation reserve. That's it. So this is what we need to know from group foreign exchange. Now let us quickly talk about our group statement of profit and loss. So group statement of profit and loss, everyone. Let's come to the next page and talk about group statement of cash flow. Group statement of cash flow. Yes, group statement of cash flow. What is it? Here, what you do is you talk about indirect method of cash flow. So you should know what are the advantages and disadvantages of direct and indirect method, first of all. Secondly, what we do in group statement of cash flow, we start with operating activity. So first we have is operating activity. Then we have investing activity. And then we lastly have financing activity. So in this, I will not teach you how to create a cash flow and what happens in the operating activity. I'm not going to teach you those basics or revise those basics. I hope you all remember. But from the group perspective, what you should know is that when you acquire a subsidiary, these are some special adjustments. When you acquire a subsidiary, what you do is you actually take the net investment or net proceeds. Net proceeds are taken as cash outflow in investing activities. So basically, you have to take this as like how much cash did you pay to acquire the subsidiary versus what is the cash and cash equivalent that the subsidiary is bringing along. So you have to take this net amount and take that in the investing activity as a cash outflow. Same applies when you dispose a subsidiary. You are supposed to take the net proceeds are taken as cash inflow in investing activity. Correct? So this is what we do in the investing activity. Then if I talk about the working capital changes, So in working capital, what is the impact of acquisition of the subsidiary and disposal of a subsidiary? So you should all know that in working capital, I'm talking about current assets and current liabilities. So in opening balances, in case of, let's talk about acquisition, step acquisition, when a subsidiary was acquired, the opening balance of current asset slash current liability does not have the results of acquired subsidiary, but the closing balance has it. Closing balance has it. So to to make it like for like, from opening balance, or to make it like for like, in opening balance, current assets and current liabilities of acquired subsidiary are added to calculate actual cash movement. Actual cash movement. So basically, you adjust your opening balance. Adjust the opening balance. So what do you do in this? How does it impact your movement? Just look at it. So how do you calculate your movement? How do you calculate the movement of your current asset or current liability? You say closing minus opening is equal to the movement. Now, if it is an increase, the movement will be positive. If it is a decrease, the movement will be negative. So you all know because increase, of course, if the receivables have increased, then the closing balance is greater than the opening. That's why it's a positive balance. And vice versa in case of decrease. So this is the formula of closing, and closing minus opening is equal to movement. So when you acquire a subsidiary, what happens is I've written that when you acquire the subsidiary, you are supposed to add the current assets and liabilities of the acquired subsidiary in the opening balance. So if I play with this equation, I would say closing minus opening, put a bracket, opening, I need to add subsidiaries result into this, right? So what is the impact on left hand side? It is closing minus opening. Open the bracket, it becomes minus subsidiary. So when you acquire a subsidiary, your movement actually reduces. So you can't simply adjust the opening balance. You have to adjust both the LHS and the RHS. So when I say deduct the results of subsidiary, I will do it both on left hand side and right hand side. So what is the conclusion? The conclusion is when subsidiary is acquired, the movement reduces. We need to, that is from the positive or negative movement, whether it is increase or decrease, negative movement, we need to deduct the results of subsidiary. Correct? Then what else is there? If we are disposing a subsidiary, what is the outcome? Again, you're disposing a subsidiary. So in case of disposal, if you are disposing a subsidiary, the results of the subsidiary disposed are not there in closing balance, but are there in opening balance. Therefore, the opening balance must be adjusted for like comparison. Like for like comparison. So what are we going to do? We will say closing minus opening is equal to movement. This is the formula. Now you will say, I need to adjust, I need to remove something from the opening. So C minus, that is O minus the subsidiary's result. So what is the impact on LHS in overall? C minus O, minus into minus is plus. So the movement is increasing. So I will increase the movement on both the sides. I will add the results of the subsidiary. So the movement increases. So the conclusion is, therefore, when the asset or when the subsidiary is disposed, the movement of working capital increases. If it is a negative movement, for example, here it is closing minus opening is equal to minus 110. So in that you will do plus the results of the subsidiary, like plus 50, minus 110 plus 50. So that would give you the real movement. So therefore, when the movement of the subsidiary is disposed, the movement of working capital increases. So when the subsidiary is acquired, the movement reduces. When the subsidiary is disposed, the movement increases. Keep that in your mind. Let it sit in your mind. And that is very important. If cash flow comes up, this is a very important concept. Lastly, what else are you supposed to do? You are supposed to look into the dividends. You need to make a proper working note of dividends. If dividends were paid to NCI, if dividends were paid to NCI, that will go into financing activity. If dividend were received, if dividend was received from associate, that will go into investing activity. If dividends were paid to the parent, that is intra-group transaction. So you need to keep that in mind. And for that, you need to create a T-shaped account of NCI associate to calculate what exactly were the dividends paid and received. So these are the things that you keep in mind for statement of cash flow in group statement of cash flow. And with that, we technically end our group accounts as well. So here, when you do your pre-populated spreadsheet, okay? So when you do your pre-populated spreadsheet, you need to keep this thing in your mind that you should know what would be its impact. I have heard some students saying that we pass a journal entry in pre-populated spreadsheet. See, journal entry is passed in a book of journal. Like it is passed when we are not making either P&L or balance sheet or cash flow only. Journal entry, for example, I pass a journal entry as P&L debit, loss allowance credit. So P&L is affected and balance sheet is also affected. So when you are making a pre-populated spreadsheet, no, it won't have dual impact. It is not that always it will have a dual impact because maybe you are making a pre-populated of just the P&L. So corresponding effect of that entry is going into the balance sheet. So you are just making one account, now you're not making the whole set of accounts. When you're required to make full set of accounts, that is P&L also, OCI also, balance sheet also, that is when we say that every additional information is having a dual impact. In this case, there is no dual impact. Sometimes there is, sometimes there is not. So there is no hard and fast rule because we are just preparing an extract of one statement. Okay. So please keep that in your mind before you think about the pre-populated spreadsheet. So all of you, please, you all must go through my Spotify podcast, okay? Spotify podcast, where you must check out the, the audio note with regards to the pre-populated spreadsheet, how to account for group accounts and how to treat your all the standards have been covered there. So Spotify podcast is available by the name of IFRS with TG. Okay. Lastly, let us quickly discuss the IFRS 2 and IS 19 also, and then I will conclude this session. So the last two standards for the day. Let's talk about IS 19, employee benefits. Okay. Employee benefits, come on. What are employee benefits? Here we talk about short-term benefits, long-term benefits, and we talk about post-retirement benefits. So basically, I'm talking about post-retirement benefits since we are just revising the important concept. So defined benefit pension scheme. So this is one of the most important topics from this standard, I would say. What we have here is if I make the one formula, everything would be clear. So if I start from a surplus or let's say a deficit situation, So what we have is we need to take the present value of the pension obligation and the fair value of the planned asset, and we will do net of them. Either we will get net pension obligation or we will get deficit. So that is net pension obligation. So deficit is net pension obligation, or you will get net pension planned asset, that is surplus. So if I start with deficit, how is my various things impacting my deficit? You guys will tell me. How does contributions made into the plan impact your deficit? Contributions made into the planned asset. Contributions increase my asset. So on the deficit, it has a negative impact. Then how does service cost? It increases my deficit. So service cost can actually be past service cost or it can be current service cost. It totally depends upon the situation given in the question, whether it's past or current. And usually the settlement and amendment and curtailment that comes under past service cost. Then what is we having is net interest. So net interest gets added into the deficit. Benefits paid out. Benefits paid out. Is there any impact of benefits paid out? The answer is no. So you will say no impact. No impact of benefits paid out because they reduce the pension obligation and they also give a corresponding reduction in planned asset. So it reduces the obligation and it also reduces the asset. So no impact of benefits paid out. So then what we have is we've dealt with everything. So we get a figure of deficit. We take a deficit figure from actuary. So actuarial valuation. You must have seen many people doing actuarial sciences these days. So they are actually doing this valuation. So actuarial valuation comes here, whatever it is. You compare it with your account balance, it won't match. This will give rise to remeasurement component. So remeasurement component goes via other comprehensive income and is never reclassified to P&L. Please remember that it is never reclassified. So this is the balancing figure. So this is what you need to understand from IS 19 altogether, that these things, service cost and net interest, they go into statement of profit and loss. And this contribution made into the planned asset, that goes into statement of cash flows. Remeasurement component goes to statement of other comprehensive income. So you need to remember that where does the particular thing go, right? That's it. That's IS 19. Let's move on. There's a concept of asset ceiling as well. So you should know that asset ceiling happens, it impacts the remeasurement component only. It's like a caution against over optimism. So you should only record your surplus up to the extent. What is asset ceiling concept? Surplus is recorded only up to the extent of refunds or future reductions in contribution. So that happens via OCI only. So asset ceiling happen via OCI only. And then if you are doing any plan amendment and settlement and curtailment, you should remember that after 2019, it was revised, the standard was revised, and they said that after 2019, after PASC, the interest rates should revise, like you should use revised interest rates after you've done a plan amendment, settlement, curtailment, and you should also revise your assumptions on which the current service cost is based. So you need to amend the interest and the assumptions on which service cost is based. So this is the crux of IS 19. Then come to the last crux for the day, IFRS 2. Yes, IFRS 2, share-based payment. So there are two kinds of share-based payment. One is equity settled share-based payment. Another is cash settled share-based payment. So when I talk about equity settled share-based payment, what is first of all my journal entry? So my journal entry, guys, to record a equity settled cash-based payment is, equity settled share-based payment is employment expense is debited and my equity is credited. I'm considering a situation of employee services. If we are giving shares in return of an asset, so we take the fair value of the asset, that is the good, and then we pass the journal entry as purchase debit or asset debit, credit, equity. So this is the journal entry. And then what is the formula to calculate the expense and the equity? You say number of employees who are getting the share options into number of share options each employee is getting, number of share option each employee is getting into the fair value of share option at grant date. Grant date is the date and which you granted the share option into first year out of the three vesting period. So like if the vesting period is 3 years, so this is the first period. So we are prorating, if it is a 3-year expense, we are saying this year we will just show 2/3. Next year we will show 3/3, or first year we will just show 1/3. Next year we will show 2/3, and then we will show 1/3, 3/3, right? The full expense. So this is what we do in our number of employees into number of share option and fair value of share option at grant date at 1/3. Then what do you do in cash settled share-based payment? The only difference in cash settled share-based payment is that I take the fair value of SAR at each reporting date. So what is the difference? Here the formula is same. Only difference is that share appreciation rights fair value is taken at each reporting date and not at grant date. Correct? And then what do we do? What do we do? After this, we simply just cash settled share-based payment. You just need to keep one thing in mind, that when cash liability is settled, it is paid at intrinsic value, which is given in the question. So it is paid at intrinsic value. And the difference in the intrinsic value cash paid versus closing liability at fair value goes to statement of profit and loss. So basically, if you check your TYU in the Kaplan text, you will understand what I'm trying to say here, that you take the opening once the vesting period is over and you are in the exercise period. You have your opening liability. From that, you deduct the cash at intrinsic value. Then you calculate your closing liability for the remaining employees. In there, you take fair value of SAR at each reporting date. Then there's a difference, and that difference goes to P&L. Correct? So this is what you need to remember. And then lastly, what we need to know is from here, once you've done the cash settled, I think this is enough for cash settled share-based payment, that, it is, yeah, I was talking about vesting conditions. So vesting conditions, there are two kinds of vesting conditions. One is market condition, another is non-market condition. So market condition, if I talk about, that is basically already de-factored into the fair value of share option or SAR. So it is already de-factored into the fair value of share option or SAR, which is coming from IFRS. IFRS 13 applies to fair value of share option. Answer is no, because they are out of the scope of IFRS 13. So this is coming from valuer's report. Like Black-Scholes model is used to value share option and SARs. So market conditions are already de-factored into the fair value of share option or SAR. But if I talk about non-market condition, so non-market conditions must be met, and they do impact the number of employees in the above formula. Number of employees in above formula. So you need to see in the question that, okay, how many people are going to meet the performance conditions, non-market conditions. For example, you say, if you work with me for next 2 years, then only you would be getting this, you'll be getting this share option. So you need to check whether the condition is being met or not. And then accordingly, you have to record the number of employees who would get that share appreciation right or share option. So non-market conditions, they do impact the number of employees. That's it. So this is what I wanted to revise from IFRS 2 and IS 19, the crux of these two standards. So I really hope that you guys are clear on what we have revised and studied today. And I would really appreciate your feedback on the session. Don't comment in the live chat. Once the recording is posted, do comment down. And because I won't be able to access the live chat, so I don't see what you guys write in the live chat, but I would be able to see after the class what you post as a comment. So the students who are studying with me, awesome. You have also joined in. The students who are not studying with me, who are self-study students, I hope this was helpful to you as well. And once I end the session, I will post the Word file for today as a PDF and I will put it in the description box. Just give me like 10 to 15 minutes max, and it will be posted in the description box. So I hope everyone has actually enjoyed the session, and I too enjoyed the session with all of you with the same, uh, I would say, with the same confidence that you came. It would must have increased, and yeah, I do understand that it is a difficult paper, so we are quite lacking in like concepts and all, but it's okay. Everyone feels like we've not studied enough. That is also okay. Okay, don't be so sad or nervous about it. When you're doing your paper now, always keep your focus on the paper and try to apply common sense. Most of the problems in life in general also they solve with common sense. If you are focused, if you're diverted, if you're tensed, if you're nervous, if you are anxious, you won't be able to do it because then everything will go bouncer. So I want everyone to promise this to themselves. You've attended the sessions. I'm not sure other people who have not attended the session, but the ones who have attended the session, at least before you leave the session, promise it to yourself that in the exam, I will not lose my focus. I will stay hydrated. It's quite summerish, especially I think everywhere it's quite summerish, the Asian country. So keep yourself hydrated and take care of your good, keep your health good also on the day of the paper. Take proper sleep before the paper. That's very important. And go with fresh mind. Don't overthink. Whenever that thought comes, what if I fail? The moment it comes, divert yourself ASAP. Divert yourself. Because if you do not divert yourself, you're screwed up. Then you'll just keep on thinking about, oh, what if I fail? Then you see a difficult question. Oh my God, now I'm going to fail for sure. And that just multiplies. Multiplier effect. You've heard about this in economics, right? Multiplier effect. So that happens on the day of the paper. And then the students say, ma'am, I blanked out. So I don't want any one of you, the 200 plus students who are watching this session, I don't want any one of you to blank out in the paper. So it is highly, highly recommended that you go on with full confidence. I have confidence in you. You have prepared enough. Maybe you've started late, you have backlogs, or you were not able to give your best. But you're giving the paper. That's the confidence. That's what you're daring to do. So you should be proud of yourself. I'm doing ACCA and I'm giving a paper. Whatever is the outcome, I am doing something great. I am career conscious. So let me do that, and let's not think about the outcome, whatever it would be. I'm sure your parents are already proud of you that you're pursuing this course and you are doing good in this course. So just stick to that and don't try to like play with your feelings or thoughts too much. We have that capacity to do so because human brain is very strong. So we try to overthink and magnify that thought. What if I fail? What will mom say? What will dad say? What will my employer think? What will my friend think? That batchmate of mine has actually passed. She will pass. She's a topper. I will not pass. Forget about everything. You had a fight, forget about it. You are ill, forget about it. You are not confident, forget about it. On the day of the exam, it's just you and the paper, and that's your just think this is my last chance. And I don't have time to dabble with my brain or debate with my brain. Any negative thought that brain throws at me, I'm going to reject it. You go off. I'm not going to talk to you. I'm just going to focus on my way. Right? All the best, all the students who were enrolled with me in my batch. We officially close our TG Professionals batch. Yeah, only the June pre-mock is left for everyone. It will be uploaded on the YouTube tomorrow. So that's it. All the very best, guys. It was a great session with all of you. All the very best. Do remember me, and I will also remember you in my prayers. Sending you all the best wishes and best vibes. May you all pass with flying colors. God bless you all. Bye bye.